Welcome to Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. It is another Jobs Friday. Oh yes, everyone. We're awaiting numbers from the Labor Department. We'll bring them to you in just under 2 minutes here. Let's start here though with the expectations. Number one, taking a look at them here on your screen as well. 214,000 is what we're expecting this number, this headline print for the NFPs, yeah, you know me, to come in at. But ultimately, the unemployment rate, we're looking for that to actually tick lower, just a hair, a smidge here, to 3.8%. That's the expectation there. And then the year over year, average hourly wage growth is expected to come in at 4.1% month over month. That figure expected to be about 0.3%, Shauna.
Yeah, Brad, I think a lot of the focus in this report beyond the headline number is going to be that wage number, what you just referenced there. That's a year over year average that we are expecting to see. Also, that month over month is going to be in focus because of what this could mean here for inflationary pressures and the Fed's fight here to tame inflation. A hotter print could potentially cause the Fed to push off that first rate cut. Still, the market very optimistic that we could see that first rate cut come in June. But if we do get a hotter than expected print on wages, that of course could cause the Fed to delay just a bit. What we are expecting to see on that month over month basis is a climb of 0.3%. So that would certainly be an uptick from what we saw last month, where we got a rise of just about 0.1%. So wage growth is still running hot. We haven't seen much really relief there, or as much as the Fed probably would like to see at this point. And again, ahead of this print, right, you have futures looks like on track to open the day higher, although all of that could change in just about 15 seconds.
Yeah, it's been interesting here, especially with some of the Fed speak that we've gotten over the course of this week. The market's lingering on every word of some of these Fed presidents who have come out and signaled where their inclination will be to lend their voice into this debate, into this conversation for the policy decision in the next meeting as well here.
And as we get the jobs print, wow, another hot number here for the month, 303,000 jobs added to the U.S. economy. Again, the expectation was for 214,000, so a beat by another wide margin. We're seeing that reaction right away in the futures market, coming off the highs there just a bit, and now we're actually moving back to the upside here. But again, that headline number, 303,000, unemployment rate ticking down 0.1% from the prior reading at 3.8%. That was in line with the street's expectations. Wages, hourly wages on a month over month basis, coming in line with expectations of gain of 0.3%. The year over year change, or growth, I should say, is 4.1%. That's a bit lower, bit softer growth than what we saw last month of 4.3%. And again, when you take a look at some of the revisions here, which we know are so critical at this time, it looks like last month, the jobs gain that we got was revised slightly lower, 270,000 there. The initial reading was 275,000 last month. But again, the headline number this month, once again, is showing the fact that the labor market remains extremely resilient and too strong, I think many people would say, for the Fed's liking at this point.
Yeah, I'm looking through some of the additional data where the job gains occurred most. Healthcare, government, construction, some of those sectors we're going to be breaking down as well with our team of reporters, our newsroom all across this right now. Buzzing, it's in a stir at this point in time. And one of the people standing by in that newsroom, we've got Jared Blickery as well here, Yahoo Finance's own, standing by at the Wi-Fi Interactive for a check of the markets here. Hey, Jared.
Hey, Brad, just stirring things up here. These four numbers right here, these four markets are U.S. stock futures, and all of those were solidly in the green. Then they dipped in the red. Let me just show you what happened in the S&P 500. Well, this actually doesn't look like it quite touched the red. Actually, that candlestick shows you it did. So we are in a fast-moving market right now. We went from up about 1/3% to break even. Now we're bouncing back to the upside. Let's take a look at what's happening in the NASDAQ. That was the S&P 500. So it breached the zero line, the unchanged line, by even more than the S&P 500, but trading back in green territory. And we'll also do the Russell 2000 futures. A very similar story there, except for the fact that they weren't as elevated as the other markets. Now, I want to go to some of the interest rate futures that we have open right now. Here's the 10-year Treasury note futures. You can see this took a sharp turn to the downside. This means the rate of the 10-year is actually going up, and this means that the higher for longer is still in play here. Maybe rate cut Fed expectations are still a bit too lofty. Those have been coming down from 6 all the way down to 2.5 to 3. So we'll have to see if that trend continues. Now, here are gold futures. Gold futures coming off a record high. Those took a dip. We've been tracking silver. Silver has been trying to break out, but it was already under some pressure here, and it is now at session lows. So the inflation trade looked like it's coming off as well. And we don't always see crude oil move on these reports, and it doesn't look like we got much movement, but it is worthwhile to note that Brent is still holding above $90 per barrel. WTI futures, WTI crude, which we follow in the United States, that's at 86.50. So we're looking at elevated levels. And this is, I would say that yesterday when we took that downturn in the market, one of the things that potentially prompted it was higher crude oil prices. Finally, I want to take a look at Bitcoin prices here. Not seeing a big reaction in Bitcoin. Sometimes we do see them because people do like to handicap the Fed through the crypto trade, but not seeing too much movement just yet, guys.
All right, Jared, thanks so much. Shauna, you've been tracking yields too on the back of this.
Yeah, we
as
are
well.
seeing a spike in yields almost across the board here. When you take a look at the 10-year, moving much higher here now, 4.38. So again, when you see a hot print, not necessarily a huge surprise that we're seeing such a spike in yields, but again, something that investors should keep very close eye on here.
For more on this report, the top expectations, we're joined by Brian Levitt, Invesco Global Market Strategist, and Dana Peterson, the Conference Board Chief Economist. Great to have you both here with us as we try and make some sense of some of the revisions that we got, as well as this hot headline print. Brian, I want to go to you first. You know, as we think about this kind of market reaction that we're also seeing here too, what do you think investors are trying to get ahead of?
It's not a bad report. We continue to show strength in the jobs data, which is good, and we didn't see wages climb on a year-over-year basis. I mean, they climbed 4.1%, but the rate of change was good, and so it's a pretty Goldilocks report. And I think everyone's been so focused on how many rate cuts we're going to get. Remember, rate cuts would have been aligned with some softness or some weakness in the economy. I would prefer a strong economic backdrop and a Fed that goes about this slowly. So I view this as all favorable news here.
What do you think, Dana? Do you agree?
Well, I'm certainly concerned about wages. I mean, wages are still well above the average we saw before the pandemic. Before that, it was roughly just under 3%. Now we're still at 4%. And so that's going to place upward pressure on overall consumer inflation. The good news is that housing inflation is slowing, but we're still getting that resistance from wages. And certainly when we look at the payrolls, yes, you did have the usual suspects like government, leisure and hospitality, non-res construction, and also healthcare driving a lot of the gains, but we saw some broadening to other sectors. So the Fed is going to be watching this to see if the labor market gets hotter and certainly causes them to pause or at least wait until they need to see more improvement in inflation before they start cutting rates.
Dana, when you see wage numbers like this, like you were just suggesting there, still remain pretty hot overall when you compare it to those pre-pandemic levels, what does that tell us then about the fight to tame inflation and the impact that this is ultimately going to have on inflation in the short term?
Well, we have to ask ourselves, why are wages still elevated? And a lot of that is because you have labor shortage in some of these key industries, especially if you have to physically show up to work. That's probably not going to be solved overnight. And so the Fed is really going to have to resist this and hope that we don't see a redux in goods and energy price inflation, which could be a risk, certainly given the fact that we're seeing shortages in energy and we're having disease and such affecting food prices. So the Fed's got a tough few months ahead of them in terms of feeling confident about beginning interest rate cuts.
I guess, Brian, is the wage front so extreme or so significant that it would throw off some of the expense profiles of companies that we track on a day in, day out basis and try to see how that might impact their margins as well, and the trade that a lot of investors have to think about too?
No, I don't think so. I mean, remember, companies are generating profits nominally, and so we're still in a good nominal growth backdrop. And again, a strong economy will be good for business. Yeah, we may see, expenses up a bit, but we're also seeing very good revenue reports. And if you these businesses have done a reasonably good job of getting back the workers. We have to remember why this all happened. This all happened because businesses cut workers and slashed inventory at the worst time 4 years ago. And so we're still coming through that. They're bringing back workers. The inventory levels are better. I don't think we're moving back into a period where we're at price instability, wages are up, corporate earnings are hit by that. I don't think that's what we're talking about. To me, this is a good backdrop of strong growth and prices that may be a little bit elevated, but I wouldn't call it price instability.
Dana, what do you think this is going to do for the Fed's timeline of cutting rates? Does it push off that first rate cut, and does it also make it a bit more likely that maybe we could only see 2 cuts before the end of the year?
Well, I think it's too early to tell. Before the May meeting, we'll get a few more inflation prints from the CPI, the PCE deflator, and certainly in June, which is when we think the Fed might start cutting interest rates, we're going to get even more inflation prints. So I think it's too early to say that the Fed is not going to go the 75 basis points that the SEP suggests, but we do need to watch these data very closely over the next few months.
I was really interested, Dana, in the consumer confidence print that came out just last week, and I was reading through some of your commentary on it as well, and recession fears continue to trend downward, both in write-in responses you mentioned, as well as by consumers' perceived likelihood of a U.S. recession over the next 12 months. Is there anything within these reports that we've seen most recent, if we're stringing together different pieces of economic data, that signals to you that, hey, maybe a recession is not coming, or if it's so far out that the Fed has a lot of room to just sit on its hands for a while?
Well, we think consumers are right. There probably is not going to be a recession, but we do think that U.S. growth is going to slow around the middle of the year, mainly because consumers probably are tapped out. They're not seeing the big wage gains. In fact, some people who quit are seeing their wage gains slow pretty materially. And also, those excess savings from the stimulus checks are probably gone, and consumers have racked up a lot of credit card debt, and the interest they're paying is very high. So we think consumers are probably going to rethink their budgets, maybe pull back a little bit on spending, and certainly not buy any homes. And so that's going to help slow the economy over the course of this year. And that actually would provide the Fed with a little bit more room to go ahead and cut interest rates, even if inflation is still a little bit sticky.
Brian, when you take a look at the market's reaction that we've seen over the last couple of minutes, obviously we're still sorting things out here ahead of the opening bell, but we initially saw a dip. Now we're back pushing higher here for futures. Does that reaction here, that gain that we're seeing pre-market, does that make sense to you?
Well, we'll see how the day plays out. I think the initial reaction to the jobs report was aligned with the Fed. We're not going to be able to get these rate cuts. But a market that's up on a strong jobs day in an environment where prices, again, are relatively stable. The cost of living may be a little bit too high, and maybe the rate of change is slightly above what the Fed wants. We could debate that, but it's not a period of price instability. And so, I think the markets should be pleased with a better nominal growth backdrop, an environment in which the jobs numbers are still strong. I mean, that's obviously supportive for spending, which is a large percentage of this economy.
Brian, just lastly, while we have both of you here, if there is one trade that traders, investors should perhaps initiate off of a report like this or think about for their portfolio this morning, off of reading this report, what would that be?
Well, it might seem a little paradoxical, but I still think investors should be looking to lock in yields. And the reason I say it's paradoxical is because this high for longer means people would say, I want to sit in money markets and get what I can get. But this environment's not going to be here forever. Things will moderate at some point. Rates will come back down at some point. So I look at this as anytime yields jump, whether it's treasuries, municipal bonds, high quality corporate bonds, take advantage of it and lock in those yields. This is an opportunity that's presenting itself to investors that may not be back for a while.
All right, we got to leave it there. Brian Levitt, Invesco's global market strategist, and Dana Peterson, the Commerce Board's chief economist. Thanks to you both for hopping on here and reacting to this. A very strong jobs print, at least with the headline numbers. Let's recap the numbers real quick before we go to break. Again, the headline number coming in much hotter than expected, 303,000 jobs were added to the U.S. economy last month. The unemployment rate coming in at 3.8%. That was in line with what the street had been expecting. Average hourly earnings here on a year-over-year basis rising 4.1%. On a month-over-month basis, we saw a gain of 0.3%. We'll be right back. The U.S. economy adding 303,000 jobs in the month of March. That was well above expectations of 214,000. Now, the sectors with the most job gains, well, they included healthcare, construction, and hospitality. We've got team coverage for you to break down those hot sectors. Brooke DePalma, Danny Romero, and Anjali Kamlani are tracking the gains. Brooke, let's start with you in the jump that we saw last month in the hospitality industry.
Yeah, good morning, Shauna. Leisure and hospitality certainly was a driver of the March jobs report. Last month, leisure and hospitality sector added 49,000 jobs, returning to pre-pandemic February 2020 levels. A big deal there for this sector. Back in February, that revised number was 43,000. And so last month, they added more jobs than what we saw back in February. Now, in particular, restaurant and bars added 28,300 jobs in the month of March, and accommodation, think hotels, think lodging, they added 3,200 jobs. But across the sector, we did see jobs added across entertainment places, museums, amusement parks, and this really does prove consumer spending power that they have right now. Consumer sentiment, really consumers continue to spend on vacations, dining out. This experiential economy seems to be moving into 2024. And also what we've heard from so many executives is that it is now easier to find employees. And this also speaks volumes to the wage growth that we've seen within the leisure and hospitality sector. The average hourly earnings for leisure and hospitality employees now sits at $21.90. That is $1 more than where we were at last year. And we're also hearing from companies like Chipotle that they're gearing up for this nicer weather. They added 19,000 jobs, or they expected to add 19,000 jobs last month, both full-time and part-time, for what they call burrito season from March to May. And so certainly wage growth and the addition of employees when this nice weather comes out will be something we'll be looking for in the next report. Danny, I know that you're keeping a closer eye on construction sector. What are you seeing there?
Brooke, it was no surprise that construction gained 39,000 jobs in March. This is one of the sectors that continues to really show strong job growth. Remember, this is an industry that is split into two categories. We have non-residential and residential construction jobs. So let's start with non-residential construction jobs. That gained 2,300 in March. And to give you some context here, non-residential construction spending has increased 24% in the last year. So what does that mean? That means we're going to see really strong movement in this area. And we can't forget about the Bipartisan Infrastructure Act. There has also, that will also trigger some more growth in this area, and also for manufacturing, as the government still needs to allocate some more funding in these areas. Moving over to residential construction, this is an area that has been a little bit more volatile, but gained 5,500 jobs in March. Some analysts do tell me that we could see some weakness in this area, especially that housing starts in the third quarter of last year actually pulled back. So we could see some of those numbers trickle down further. Finally, wages. That has not slowed down for construction workers. Wages for these workers has increased over 5% in the last 2 years. At the end of the day, what does this mean? If you're a construction worker and you're looking for a job, you're going to get hired. There's opportunity out there, but let's switch over to healthcare. Anjali Kimlani's watching there. What have you seen there?
That's right, Danny. Healthcare adding an astounding 72,000 jobs, this month, and that is still higher than last month by quite a stretch, in addition to being higher than the 12-month average of about 60,000 jobs per month. And that's something that we continue to watch, because the industry is facing what we know is a physician shortage for the next decade, as well as looking at where the jobs are going. There is still a demand and supply issue in this industry, and will be for some time. We do see the numbers creeping back up above pre-pandemic levels, so at least a recovery from the loss of business during the pandemic has already been taken care of. If you take a look at where the jobs really came back, we've seen hospital as well as outpatient centers really taking the lead there, with 28 and 27,000 jobs added in those areas. And that is sort of where the patients are going. That's something that the industry is really looking at, is how to staff up in areas where patients are actually wanting to get care and need care. In addition, we also know the large aging population is contributing to the job growth, 18,000 jobs added there. And those are the three sectors we continue to see consistent job growth month over month. Hospitals have been struggling with trying to fill. So while there are jobs added, it's important to note that there's even more jobs available and more demand for these positions. Regulatory limits, as well as sort of staffing ratios, and a lot of different factors add into why hospitals can't necessarily staff up to where they need. So ongoing shortages, despite this strong report, is what's going on in the health sector.
Yeah, Anjali, you mentioned some of the industry trends that are driving demand for specific role or function types. That healthcare sector, red hot. How does that continue, that sector, and why does it continue to add so many jobs each month?
Well, you know what's interesting, Brad, is actually these jobs are just of what's tracked. There's actually a large gap in what we don't know of where jobs are going in telehealth or where they're going in corporate and startup. So there might be even more movement on that side of the scale, but that's not tracked in these reports. So that's also where you see sort of the movement happening. There's large physician burnout. There's a lot of nurse burnout as well. And nurses are, in fact, getting paid higher because of the sort of leaning on them for the work that is being left over and they need to pick up on. So there's a huge shift happening, a huge transformation happening in this industry. So you're going to definitely continue seeing this sector continue to be strong throughout the months.
All right, Anjali, Danny, Brooke, thank you all so much for really wrapping up this March jobs report for us. Appreciate it. Well, the U.S. added 303,000 jobs in March, well above the expectation of 214,000. Let's zero in on the tech sector. The industry is seeing sharp decelerations in hiring in recent years, leading job cut announcements during the month of March, according to Challenger, Gray, and Christmas. But our next guest says that the sector is now showing signs of recovery and improved momentum. For more, we've got Corey Cantenga, who is the head of economics for the Americas at LinkedIn. Great to have you here in studio with us this morning, Corey, on Jobs Day. As we're all celebrating, we're all trying to figure out, okay, hotter than expected. You're zeroing in here on tech. What are you seeing there?
So the tech sector has actually become pretty stable since about June 2023.
Yeah.
So while overall hiring has come down about 8%, we actually see it up in tech about 5 to 8%. So tech has sort of started to stabilize. Don't get me wrong, hiring is still slow in tech compared to what it was a few years ago, even prior to the pandemic. But we are starting to see tech level out. We're starting to see layoffs in tech stabilize as well. And so some of what we're seeing for layoffs in tech is seasonal. Some of it is that there are just these huge companies that make big headlines. But overall, layoffs are starting to come down. Hiring is starting to level out at a steady pace in tech.
Corey, when you take a look at the sectors, the sector hiring, the basis that we saw there, healthcare, which we just went through, construction, hospitality, among the sectors that added the most jobs here this past month, is that consistent with what you're seeing on your platform?
So what we're seeing on our platform is that there are certain sectors that are a bit more stable. So for example, government administration is one of the top 3 sectors we're seeing. There's also what we call consumer services, which is kind of a catch-all for things that don't change very much, repairs, laundry, civil society. And so we see those areas being pretty stable on LinkedIn in terms of hiring. Well, that's consistent with what we're seeing in the jobs report. We also see construction as one of the areas that's doing pretty well year over year compared to a lot of other sectors.
When I look at this participation number, we had a slight tick higher, moderation higher, even though the report will say, it didn't move much. I mean, it's significant though. When you think about the broader number of people, and we see the circle and the avatar that people have on there saying open to work or hiring now on LinkedIn. What are you seeing in terms of the number of people that are actively looking for jobs on the LinkedIn platform and the number of engagements as well that are leading to some of these job postings being filled?
We certainly see more engagement and more job-seeking activity.
Yeah.
So the open to work signal has been up. We've also seen applicants putting in more applications. So that's up about 14% compared to November. So we are seeing more job-seeking activity on LinkedIn, even though there are less job postings to get.
Interesting.
What does that tell you then just about competition and the likelihood that that competition, it sounds like, will increase here, at least over the next couple of months?
Well, the overall projection for the economy this year is that we're still expecting some slowdown as the Fed rate hikes peak. We're going to get hit a little bit more. We haven't fully seen the effect of what the Fed has done. So we are expecting there to be a little more air let out of the labor market. And as a result, there's probably going to be more competition between workers.
All right, Corey Cantenga, we have to leave it there. Head of economics for the Americas at LinkedIn. Thanks so much for joining us here at the desk. Keep it right here on Yahoo Finance. Much more of the market action ahead. Again, taking a look at futures and where we are trading just about 30 minutes ahead of the open. We are seeing some gains still across the board, pointing to the fact that we are going to open in positive territory. Now this move higher coming on the heels of that stronger than expected jobs print. 303,000 jobs were added to the U.S. economy last month. Unemployment rate coming in at 3.8% and wages remaining high here on a year-over-year basis. That growth coming in at 4.1%. We'll be right back. It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief. It's the ultimate guide to help you, the investor, make smarter decisions for your portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a lot of ground to cover this Friday morning. Jobs day. Futures climbing higher following a much hotter than expected March jobs report. The added jobs, 303,000 jobs, were added for the non-farm payrolls in March in the U.S. compared to 214,000. That was the expectation. Unemployment also ticking lower to 3.8%, in line with expectations.
And it's a good time to talk rate cuts. Are we one and done for the year? Now, Neil Kashkari saying that we could be none and done. And also taking a look at oil on the boil. We will take a look at what could send Brent to $100. So let's get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Jen Schomburger, and Ines Ferre have more.
Hey, Shauna, the American labor market is holding firm. The March jobs report blows past expectations with 300,000 jobs added. Now, this means the Fed's higher for longer conversation is likely not going away just yet.
And the perfect storm for the data-dependent Fed. Minneapolis's Neil Kashkari warning the Fed may not end up cutting rates at all this year if inflation continues moving sideways, though he has at this point penciled in 2 rate cuts for this year. Big question now for investors, what, if anything, is there concrete that could cause the Fed to cut rates this year?
And the eternal push-pull for oil. Brent's ascent continues, now hovering around the $90 mark on escalating geopolitical tensions in the Middle East. And OPEC Plus standing firm on policy, but could increased inventories keep a lid on the rally?
The March jobs report coming in much hotter than expected today. More than 300,000 jobs were added last month during the month of March. But what are wages telling us? To break down what you may have missed in this report, Yahoo Finance's very own Josh Schaefer is here. Yeah, forget about the headline number.
People are still getting paid, Brad.
How
That's
much
what
are they
wages are
making?
telling us, right? People are still making money out there. They're making a little bit less money than they're seeing slower increases than they were seeing before, right? That's sort of the takeaway from that 4.1% number, down from 4.3. Remember, we saw the big spike in January. I believe that number was 4.5% year over year growth. And the reason I'm highlighting wages here, guys, is because when you have a hot number like this with a big increase in the non-farm additions, a big increase unemployment coming down, you have this strong picture. People are going to look at, okay, are wages going up significantly too? And then we're going to be talking a lot about inflation. I think this is sort of the balancing piece of this report that stood out to me. Of at least we didn't have a massive uptick in wages with the hot number for everyone to sort of freak out about the print being too hot. I don't know. That was.
Yeah, no, I think you're right to point that out, right? It's kind of the silver lining in this report, I guess, compared to what it could have been. But still, though, when you take a look at the fact that it is a 4.1% increase on a year-over-year basis, 0.3 of a move to the upside or growth, I should say, on a month-over-month basis, is that, though, still way too hot for the Fed, given how resilient the economy is and given how the fact that the jobs market remains, once again, to be holding up much stronger than we anticipated.
I was listening to Dana Peterson on the show a little while ago, and it seemed like she said yes, right? Like that number, 4.1% and 0.3% is not a number people are particularly happy with in the long run. But I also think it's the March jobs report. We're sitting here in April. I don't think anyone woke up this morning thinking we were going to get some number that was going to be in pace with 2% inflation, right? It's back to the long-term story here of we're slowly getting there. We're slowly getting there. And so every month you want to see that number come down a little bit, but the number's not suddenly going to go down to 3.5%, which some economists have highlighted for year-over-year growth that they want to see to be in track with 2% inflation. Maybe we'll be talking about that number in 6 months. Maybe we'll be talking about that number in a year. I have no clue. But it's going to take time to get there. And so I would say for now, at least it's coming down. And then the other thing I liked in the report too was the labor force participation rate coming back up. You also had hours work coming back up, sort of some supply side factors there. And we know Powell recently talked about that and started highlighting maybe we're getting help on the supply side here. So maybe that's a positive story overall for the US economy. And those were some of the things that sort of stuck out to me rather than, I get it. the inflation story and Fed rate cuts, we're going to see those Fed rate cut futures move today. It might move all the way off June. It's starting to move off June. People are moving to July. Yeah. It will be okay, Brad, if we wait till July.
That'll be fine. I mean, as long as people keep making money.
I said to Jared, if they push to September, we can take the summer off.
Really?
Right. Not bad then.
Not
well,
opposed.
The Fed swaps right now they've fully shifted. They're fully pricing in. They have the full pricing of a rate cut now to September.
There we go.
So there we go. Right after Labor Day, it looks like. Right, Josh. Thanks so much. Let's continue talking about this hotter than expected print, because when you take a look at futures, well, they are actually rising on the back of another hot jobs report. The U.S. economy adding 303,000 jobs in March. It's well above what the street had been looking for. For more on what exactly this means for equities and what investors need to know ahead of the trading day, we want to bring in Marvin Lowe. He's State Street's senior global macro strategist. Marvin, it's great to see you. So just first, your reaction to this print and what you think it essentially means for equities, because at least at this point, futures still remain trading to the upside here.
Yeah, I mean, it was a great number for sure. The economy is in a solid place. We're adding a lot of new wages that are going to continue to support spending. As Josh mentioned, we didn't get an acceleration in wages. So, for stocks, it's a little bit of a Goldilocks type of number. The economy is still humming along, quite well. And in terms of an accelerating inflation picture, we didn't necessarily get that. So a little bit of something for everyone.
It certainly is. And Marvin, I guess I would wonder how you assess the different industries and sectors where we're continuing to see the most job growth kind of outpace, or at least put the rest of this number on its back as well here, and your assessment of that.
Yeah, for sure. So it is the sectors that have driven a lot of the gains over the course of the last few months. So there's certainly sectors that it's been difficult to replenish after the pandemic. Healthcare continues to be a big part of it. Government, which is, ultimately a function of what legislative taxes are passed, is something that has been driving things, not necessarily as, let's say, accretive to the economy as some of the more private sector driven things. But, it's a continuation of that. I think for those that are looking for excuses to say that the job number wasn't as great, there were weather related impacts, particularly around construction, particularly around maybe some of the entertainment sectors. But it was a good number. I don't think anybody's going to be able to poke too many holes through this.
Marvin, do you think it's enough, though, for the Fed to potentially push off that first rate cut?
You know what? At this point, every data point is real. I don't think they're there yet. We saw how split they were. It was 10 who thought we were going to get 3. It was 9 who thought we were going to only get 2. And I think everyone's going to be in a camp where they're going to be able to point to something that continues to make them believe that. Still a lot of data between now and June. Certainly, I think you and Josh were talking about July. Certainly a lot of data between now and July. I would point out that kind of the way you calculate inflation, it gets harder from a year-over-year perspective after May. We call that base effects. And if they're not able to cut in the summer, some of those inflation numbers, especially if they keep coming in this kind of like 0.3 of a month increase that we've seen, it's going to be really, really hard for them to reassess things until the end of the year.
I mean, I'm looking at the CME Fed Watch tool right now. It's jumped by about 12, we'll say 11 percentage points right now between the current, us just having no cut, having a pause, and this is for the June meeting. So now, if we look further out, the pacing of any cuts that they put forward, when you hear Fed speak over the course of this week talking about, hey, maybe no cuts, maybe none and done, what does that signal to you?
I mean, so again, we were pretty split from the perspective of 3 to 2. Saying that there are no cuts really would, I think, change the belief that policy is restrictive. I haven't really heard that as a widespread view from the Fed. Most on the Fed still believe that a 5.5% funds rate is slowing the economy. And if they continue to believe that, then there is a reason for them to normalize. To say that there are no cuts this year would mean that, that 5.5% probably can't come down. And that's a much different type of conversation than what the Fed has put forward. So, Kashkari is a little bit of an outlier from that perspective. But, it's certainly something that we've been looking at for sure. Just how restrictive this policy is when you can add that many jobs every month.
Marvin, when you take a look at the losses that we've seen here since the start of this quarter, so really this week, we certainly have seen some worry creep back into the market, a lot of that pertaining to the Fed, a lot of that just on the heels also of the massive run-up that we saw in the first quarter and in 2023. Is some of the sell-off, though, the selling that we've seen over the last several trading days, do you think that's a bit overdone?
You know what? I do, but I can understand, taking some of those profits and in our world going without a big position into some of these bigger numbers kind of makes prudent sense, particularly if you've got gains. So there definitely is profit taking into it. And let's not forget the geopolitical aspects of things, which are fluid and, at least on a day-to-day basis, seem to be getting worse. So when you have that going into the weekend, when you have CPI next week, are you really taking big risk positions? And I think a lot of professional money managers are like, you know what, we've got some profits, let's book them, and kind of let's see how the weekend and CPI evolve.
Marvin Lowe, State Street Senior Global Macro Strategist. Marvin, thanks so much for taking the time here this morning. Appreciate it. Well, Brent crude continues its ascent. The commodity space has its attention firmly on the Middle East amid heightened geopolitical tensions. Iran blaming Israel for a deadly airstrike on its embassy in Syria and vowing revenge. OPEC Plus also having an impact on the move in prices, but can it push it towards $100 a barrel? For all this and much, much more, we've got Yahoo Finance's Inez Ferre here to break it down. Hey, Inez.
Hey, Brad. Yeah, once we start hitting $90 a barrel for Brent crude, then analysts start talking about $100 a barrel. So we are watching WTI that's above $86 a barrel, Brent crude above $91 a barrel. So this is a very important psychological level because at some point when oil gets too high, it does start to create demand destruction. But a lot of reasons of why we've gotten here with year to date, Brent crude up 20%, WTI up more than 23%. A lot of this has to do with geopolitical risks. A lot of this also has to do with OPEC Plus standing firm on its output cuts. We did have inventories last week that rose unexpectedly, but that could have more of an effect with respect to the refineries because we've had some refineries that have been down. So they may have been waiting for those barrels for that oil to refine that oil. So that may explain part of the reason why we saw an increase in inventories. Doesn't necessarily say too much about demand. But look, some analysts are saying that in order to get to $100 a barrel, things would have to stay the way they are right now. But there are levers that could be pulled beforehand. For example, demand destruction could start kicking in. You could have the U.S. also release some more SPR as well. One analyst saying that even though this rally is justified, you are looking right now at an overbought scenario. So there is a correction that some analysts are expecting soon.
All right, Inez, thanks so much for that. Well, U.S. Treasury Secretary Janet Yellen kicking off her first full day of official meetings in China. Now, Yellen calling on China's government to address manufacturing overcapacity and also create a level playing field for American companies. Yahoo Finance's Jennifer Schomburger has the highlights, joining us from outside the Labor Department here this morning. Jennifer.
Good morning, Shauna. That's exactly right. U.S. Treasury Secretary Janet Yellen kicking off her second trip to China as secretary, where she is warning about the overcapacity in production of certain goods in sectors, including electric vehicles and solar panels, warning that could undercut U.S. businesses and U.S. jobs. She says that she sees emerging new risks in certain sectors in China as it relates to certain goods production. Asked by reporters whether she would consider trade barriers to China if officials do not heed her warnings, she says that hasn't been planned, but it's certainly under consideration. Yellen is today in the province of Guangdong. That's the country's economic powerhouse. This ahead of heading to Beijing next week, where she will meet with her counterpart, Vice Premier He. Ahead of that, she warned He that the U.S. and China need to create a level playing field. Now, senior administration officials tell reporters that they do not expect any deliverables from this trip, though they say the relationship between the U.S. and China has improved markedly. Guys?
All right, thanks so much, Jen. We should mention you're also going to be speaking to Labor Secretary Julie Su later this hour.
That's right.
Do not want to miss that. Acting Secretary of Labor Julie Su joining our own Jennifer Schonberger, 9:45 a.m. Coming up, everyone, leading the street. Netflix has a fresh high on its price target. Find out from who, why, and if it's won the streaming war. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. 15 minutes to the opening bell. Welcome back. Let's get to some trending tickers that we're watching for you today. A new Wall Street high for Netflix. Shares of NFLX higher right now. Pivotal Research Group raising its price target on the stock to $765 from $700. The firm reiterating its buy rating, and the analyst behind the call said Netflix has won the streaming war, strong words there, and will outperform estimates for subscriber growth. I mean, they certainly have kind of set the bar for even activist campaigns to say, hey, why aren't you doing what Netflix is doing and providing us some of those fat margins? So ultimately, Netflix not only creating perhaps a de facto standard, but also trying to make sure that it's meeting the expectations of Pivotal, who's looking for some big forecasts here on ARPU, that average revenue per user, primary driver of that $65 price target increase that we saw.
Yeah, they're expecting strong subscriber growth, that strong ARPU number that you were just talking about, also free cash flow here, that free cash flow generation being the driving factors of what they think is going to continue Netflix's momentum here to the upside. You can see it on your screen. We've had this steady climb to the upside ever since really the end of October, beginning of November here. We certainly have been up about 77% over the last year, even just year to date. Gains looking at just around 27%. You compare that to some of the mixed reporting or mixed performance, I should say, from some of the peers on the street since the start of the year. You've got Disney, which has gained 30%, obviously ahead of that, had been an underperformer here, but Comcast is down just around 6%. You have Charter Communications, that's well in the red since the start of the year. Roku has also been under a tremendous amount of pressure. So we got some of that comparison up on your screen. Also Paramount there, one of the names that has been declining as well, has been struggling to keep up with some of the larger peers. So Pivotal Research making the case that yes, Netflix is by far the leader right now. They're confident that Netflix is going to be able to maintain that moat, and making the argument that the bigger they get, the stronger that moat becomes, and also the stronger advantage it ultimately has over its rivals and over its peers.
Just two contingencies I want to point out that they actually mention are part of this valuation as well, and there are risks that the company and Pivotal has noted. Netflix has a huge content obligation, about $22 billion worth of commitments there. So that being one thing, and they had to make sure that they also included that within the risks. But also the other spending element here, the investment in live sports, that could drive down long-term margin outlooks, offset partially by higher forecasted subscribers, likely significantly expanded advertising opportunity as well. So that live sports element that Netflix has really been trying to bring on, I don't know if the golf programming has been working the same that they expected, but I tuned in.
Of course you did.
Yeah, I know. I'm a sucker.
I don't know if you're exactly, I don't know if, there's no surprise that you are a sucker for that and that you would tune in and you're actually going golfing this weekend, but that's a whole nother topic.
Yes, weekend plans.
All right, let's take a look at another trending ticker here on Yahoo Finance, and it's Samsung. We're seeing a bit of a move here this morning. It is, though, seeing a turnaround in the chip sector. One of the companies that it also expects that trend to continue here, saying that it expects to post a 931% increase in first quarter operating profit. Now, we should mention that Samsung is the world's largest memory chip maker. We bring this up, and that massive increase that it is expecting here for the first quarter comes off of pretty depressed levels. We know pricing had been under pressure. They had a glut of inventory coming out of the pandemic. Also, just the fact that demand for smartphones and laptops have been struggling just a bit. That had been weighing on Samsung. So they are starting to see that turn around just a bit. Demand improve, pricing getting a bit stronger. And as a result, Samsung expecting to really benefit from that during the first quarter, and then also that trend to continue here throughout the year.
Yeah, really fascinating. And the share price reaction that we're seeing here, I wonder for investors that are going to continue to kind of look through this report in the broader demand environment. I mean, Samsung, especially within this global smartphone market where last year Apple was expected to get up to that 19.9% of the total market share in operating system. And for Samsung, what you're trying to make sure is that at the end of the day, these handsets where there's going to be a whole new level or perhaps layer of lighter fluid that gets poured onto this industry once generative AI really is infused and is tangible within those product experiences. I think that's where we're going to see that next iteration of innovation coming from companies like Samsung, companies like Apple, but it's going to be at what uptick in the adoption rate they see early on prior to it actually getting to a critical mass type of moment here. But that's some of the kind of far off things that we're going to be tracking going forward.
Certainly. All right, well, let's take a step back and broaden out the conversation. Take a look at chip makers, because some of that momentum that we've been talking about since the start of the year, it's starting to fade just a bit. Many of these chip stocks had been under pressure since the start of the second quarter. You've got NVIDIA on your screen there, that 5-day look showing declines of just about 4.8%, just about a decline of 5%. You also see AMD and Intel under a bit of pressure as well. Now, the chip maker, though, leading the market rally, that has been NVIDIA to start the year. It's still up over 70% since January 1st. Madison Mills is here to explain this type of action. And Maddie, I think the question is whether or not investors are starting to sour on some of these names that have been leading so much of this momentum.
Well, it's really weird to go into a day like this and have the news that you just discussed with Samsung and then have Samsung stock be down when those numbers are so incredible. So when I see a weird vibe like that, I think, how can I figure out what's going on? And sometimes the macro does outweigh some of the fundamentals and the micro. So I took a look at what's going on over in Asia this morning, and it does appear that the Nikkei index is coming off of its highs. We've been talking about this index hitting record-breaking highs despite Japan being near recessionary territory, but coming off of those highs, and that's going to weigh on some of these names, the Nvidias, the AMDs that are impacted by this index, and a lot of the suppliers to Nvidia and AMD and some of these other chips names are within that index. So that's an indication of some of the read-through to some of those bigger chips names. I also want to take a look at the yen, because the yen in Japan is stronger off of a potential pricing in that the BOJ is going to hike again. That might sound familiar because here in the US, the dollar is stronger this morning as we are digesting that jobs print coming in hotter than anticipated, much hotter, and thinking that the Federal Reserve may not have a reason to cut anytime soon. So that is also pouring a little bit of cold water on some of these chips names as well. Now, looking at some of the tech sector movement, tech was the biggest laggard as of the close yesterday. We are not seeing that so far in today's trade. So I'm going to be interested in seeing how this kind of develops throughout the day. Also, just looking at idiosyncratic moves when you have a company like AMD that has been seen as very overvalued compared even to some of the other chips names. Some of these movements from the macro level might be not an excuse, but a reason to take some profit off the top and get out of this name due to some of those bigger movements there.
All right, Maddie, thanks so much for breaking that down for us. Certainly interesting moves that many investors have taken note of over the last several trading days. We've got the opening bell on Wall Street on the other side of the break, but Brad, one of your top trending tickers, one of your favorite tickers, I should say, is trending this morning.
This is the Brad trade, indeed. Plus, if donuts make you go nuts, you're going to love this upgrade. We'll talk about Krispy Kreme. The hotline is on. Let's go. You're watching Yahoo Finance. Ping pong. All right, time for the opening bell on Wall Street and in Midtown Manhattan, where you've got Murano ringing the opening bell. And, oh man, you've got a Canadian Tux convention taking place at the NYSE, where Levi's is ringing the opening bell there. Of course, we've got that conversation with Harmeet Singh coming up here on Yahoo Finance today. Got a little funfetti on a Friday there in Midtown Manhattan at the NASDAQ as well. All right, we've kicked off this trading session. We're wrapping up the first trading week here in April. My goodness, it's flown. But we're taking a look here at some of the biggest movers. Out of the gate, we got some movement on the Dow, the NASDAQ, and the S&P 500. The Dow, well, it looked like it was the lone gainer for a moment here. We're waiting for the NASDAQ to calibrate, but ultimately seeing, there we go, all three major averages in positive territory to start the day.
We certainly are. We have the Dow up just around 21 points here, so not a huge move to the upside. The S&P also up about 0.2%, as the NASDAQ opens here. That's gaining about 0.3%. So consistent with the pricing action and the reaction that we got following the hotter than expected jobs print ahead of the bell this morning. A lot of this optimism being attributed to the fact that we did see a bit of a cooling when it comes to that wage growth number. Year basis, it did tick lower compared to the number that we got just last month. Taking a look maybe at a 5-day chart, because we have seen a bit of selling this week. So this move to the upside here certainly welcomed here for investors on a 5-day basis. On a weekly basis, we're still looking at losses of just over 1.5% for the NASDAQ. Also, the S&P heading into today's trading day have been on track for the worst week that we could see in just about 5 months. So certainly important to keep an eye on there. Let's get to the rest of the market action, including the commodity space and some of the movement that we're seeing there. Jared Blickery is standing by with that. Jared.
Thank you, Shauna. Let's take a look at the U.S. dollar index first. I'm going to put this up on the Wi-Fi Interactive behind me, and this is what's happening this over the last 5 days. Now, we have seen a little bit of a rise over the last 2 days, but let me put some context to this. We've had basically a double top this year, and the higher the dollar, the more that weighs on commodities and risk markets overall. So you can see we're in kind of a precarious position here. If we head higher because of the higher for longer mantra that the Fed, that whole narrative plays out, well, that has important implications for everything. It could weigh on commodities. But here we have what's happening today. Wheat actually is the biggest gainer overnight, up 2%. Palladium, biggest loser, down about 4%. But I want to check out what's happened over the last 5 days. I think this is instructive. Commodities tend to mean revert over the time, but they can trend over shorter periods of time. And right now we are in a commodities rally for a lot of these different markets. So we have lean hogs, we have coffee up 8%, we have silver up 7% this week. And just let's take a look at the 1-year silver futures. They've been stuck in a holding pattern here, but have recently broken to the upside. And that's a very similar situation that we have for gold. Gold is up 3.5% this week. It's coming off a record high only yesterday. And right now, let's check out the overnight price action. Pretty interesting. We took a little bit of a dip after the payroll report, but we are now back above the highs before. So that just shows you the strength that is embedded in this market. We do have cocoa futures. I want to highlight those because those have backed off recent highs, but still very, very volatile. Bottom line is commodities are trending now and mostly to the upside.
All right, Jared, thanks so much. Teeing up today's trading activity for us here. We appreciate it. Investors, they're looking for progress when it comes to generative AI and wondering when companies will begin to really live up to some of those expectations around the technology. Our next guest predicting this year we will see concrete steps with names like Microsoft to benefit from the advances. Let's bring in Brent Thill, Jefferies senior analyst, to discuss where investors should be looking. Brent, always a pleasure to grab some time with you and get your insights. Take us into the thesis here, and you know it's really going to come on what may be the pricing mechanism here and come down to the pricing that for some of these solutions companies like Microsoft are putting into the market.
Yeah, AI was a hype year in 23. 24 will be a start of the implementation, and 25 will really be the revenue year. So we still have a ways to go for software. So if you look at companies like NVIDIA, Dell, all the hardware infrastructure, right, all the attention's there because all these companies that are putting AI in are having to put that critical infrastructure in now, right? The software companies are all buying those companies to enable their services, but those services in most parts aren't even live yet today. And they're in what we call POC, or proof of concept. So companies are trialing them, but they won't go live until later in 24. So the way to play AI right now, in our opinion, is, you know, our clients are continuing to be long the hardware and semi names, NVIDIA, AMD, Dell. And then as we get to later in the year, there's going to be a switch over, we believe, more to software, because these software services will go live on top of that hardware. And so, if you've seen the SMH, which is the semi index, has absolutely ripped year to date, and the IGV, which is a software index, has massively underperformed. As many of our clients say, the IGV stands for "I give up." Why don't I just own the semi index? So right now, we look at companies like Microsoft, Amazon, Google, in really good shape. And there are three characteristics for AI to work. You have to have data, you have to have users, and you have to have a lot of money. I mean, there's chatter that Microsoft's putting a $100 billion new data center in. Who knows if that number is right? Even if it was wrong by 50%, you're talking about a $50 billion data center. These are not, you can't do this if you're a startup. And this is why all these AI startups are starting to find partners. OpenAI with Microsoft, Anthropic with Amazon and Google, Cohere with Oracle. You're seeing alignments, and those alignments are coming together. They're building the software, and that, again, will be a bigger year for software and internet for AI in 2025 than 24. We'll start to see the ramp of these proof of concepts go into production, most likely in the back half of this year again, but they're going to be baby implementations, little AI projects here and there, right? So we're not going to see mass market for a while, because companies are still struggling with data governance, and is AI going to go wrong, and is the intern going to try to query the payroll data for the employee base, all the things that you worry about. And so you have to be very careful. So it's going to start private, it's going to start small, and it's going to build over time. And so the enterprise plays that we like would be Microsoft and Amazon, and the consumer plays we like would be Meta and Google.
From when it comes to the Microsoft and Google comparison, obviously very different business models, obviously very different points here just in terms of AI adoption. Microsoft, like you're saying, largely viewed as the winner, at least at this stage, with AI adoption. Some of that fear, though, it sounds like maybe you think is a bit overblown, pointing back to the fact that a lot of people love to make the case that Google is far behind Microsoft when it comes to AI adoption. Is that simply not the case?
I think Google... the fear on Google right now is I think they've done a poor job of communicating what they have. And I think they have more, underneath the hood of the car. And so what I mean is when Microsoft started this AI revolution last year, right? They are the first ones, at least in software, that came out, early last year and said, this is the age of AI. And I think they caught Amazon and Google flat-footed. And then next thing you know, Google's trying to race up, and they're coming from behind, and they're effectively trying to demonstrate what Bard was, or trying to show a number of these other technologies, and they did a poor job. And most of these demos kind of fell down. So we think that ultimately, again, there's more technology. I don't think it's all quite ready to go for prime time, as we've been talking about. None of these large enterprises are stampeding into AI yet, despite what you read. And so Google has time, but they have to get their act together. They have to get their demos together. They have to get effectively alignment. Look, this is not anything that any of our institutional investors don't know, but Google's been a really difficult company as investors to deal with. They basically say, hey, look, we don't care what you think. We can't really talk to you. We're going to build it. If you don't like it, we don't care, right? That's not the attitude that Amazon, Microsoft, and Meta take. And so they need to improve their communication with their investors. They need to improve their communication of their AI products, because there's been some pretty loud cries about that they need to do a better job, and we agree with that, and they can do it. So if they put these simple things together, their multiple can go higher without doing anything new. And then they need to execute on AI. We think, again, a lot of these tools are there. We think that ultimately a lot of these chatbots may be integrated into Google search. Even if you're in a different system, you may ask a question of a chatbot. It may actually be using Google data. And so I think there's an opportunity to combine search and AI together. And in Google, we think, again, has already demonstrated AI for many, many years across many of their products. And I don't think investors are really digging deep to see what they've already built. It gives them a great platform to go from going forward.
Brent, as we continue to hear about NVIDIA perhaps being the de facto generative AI chip company or portfolio play, is there an unsung hero that's out there that you may be tracking at this juncture that investors might be missing at this point as we're kind of scaling up the broader generative AI uses, the cases, and the number of people that will actually have some type of product or service that they're able to see a difference in their daily life? And what is that company from your perspective?
Well, I mean, I think there are a bunch of large and mid-cap names. You know, Salesforce.com doesn't get a lot of attention in AI. They're kind of late, but they're going to play catch up and be in a really good spot. You know, Adobe is the crowd. You know, everyone hates the stock right now. I think Adobe has more AI than people give them credit. The minute that OpenAI Sora video came out, everyone said Adobe's dead. And this reminds me when Steve Jobs was alive and he used a bashing Adobe Flash, and everyone thought Adobe was dead, and they weren't. The stock was 30 and it went to 600. So Adobe is another name that we like in SMID cap, Elastic, ESTC. Their foundation is they're like the Google search for the enterprise, and underpinning AI is search. And so Elastic, we think, is a great company to benefit, in our opinion. So we're actually a big fan of what's happening at Elastic.
Brent Thill, Jefferies senior analyst. Brent, thanks again for taking the time here today. Appreciate it.
Thanks, guys.
Certainly. And we're also taking a look at shares of Krispy Kreme, rallying in today's trade after Piper Sandler upped its rating on the stock from neutral to overweight and raised the price target to $20 per share. Analysts saying that the donut chain's partnership with McDonald's is a game changer for the brand, setting the stage for major expansion of the brand in the U.S. over the next few years. You made fun of me. Y'all made fun of me here on set when I said this is huge for the company. This is massive for Krispy Kreme. The analysts, they tend to agree here.
Oh, I think it's massive for Krispy Kreme. I don't know how massive it is for McDonald's.
For McDonald's?
But I think that this is huge for Krispy Kreme, right? Getting into McDonald's locations obviously makes a lot of sense. Brad, when I was reading this analyst note this morning, it was a little funny because he almost sounded a bit more optimistic than even you are
he did.
on Krispy Kreme. You mentioned that game-changing line. That stuck out to me. You're also saying that things are starting to change in real time. And he really expects this narrative around Krispy Kreme that has struggled for some time to materially improve. A lot of that on the back of this McDonald's partnership. I think the question, though, is what exactly the traffic is going to look like, what that uptake rate is going to look like, and whether or not people are actually going to be making more trips to McDonald's to see how big of a boost this will be to McDonald's bottom line, not only for Krispy Kreme. But for Krispy Kreme, there's no argument. Obviously, this is a great news.
Well, yeah, for Krispy Kreme and for the hit that we had seen that you were mentioning a moment ago and how investors were trying to evaluate this, I think there was the overhang, and there likely still is, about what GLP-1s, what Ozempic, what all of the other weight loss drugs, especially for those who are diabetic or those who are just trying to, take advantage of some of the new weight loss solutions out there and the testing that's come forward. I mean, at the end of the day, I think that's one of the overhangs that still exists. But for Krispy Kreme, for McDonald's, a solid tie-up. Better for Krispy Kreme, though, here. It's sweet. It's really sweet. Guys, coming up, we're going to be jumping over to Washington, D.C., where our very own Jennifer Schonberger will be joined by Acting Secretary of Labor Julie Su to discuss the job numbers. That's after this break.
Welcome back to Yahoo Finance. I'm Jennifer Schonberger. A Goldilocks jobs report for the month of March. The economy adding a whopping 303,000 jobs last month, while wage growth remained in check and the unemployment rate held steady at 3.8%. For more insight on this morning's jobs report, I want to welcome into the program Acting Labor Secretary Julie Su. Secretary Su, always great to see you. Thank you so much for joining me.
Thank you.
Another strong jobs report. We keep getting these month after month and widespread across different sectors. How much of this is because of the president's policies, whether it's been the CHIPS Act, the Infrastructure Act, or the IRA?
Yeah, this is 100% exactly what President Biden's vision for the country is. When we invest in America, especially when we invest in America's workers, build an economy from the middle out and the bottom up, we can see sustained and broad-based growth across the board. So this was a very strong another labor market report that demonstrates stable, steady growth. Not just the 303,000 jobs created, but as you said, the unemployment rate has remained under 4% now for over 2 years. That's the longest stretch since the 1970s. Real wages are up, as you already mentioned, and labor force participation rate remains strong. So it's not just because, this is very much a continued labor market in which people are coming into the labor force, looking for jobs, finding jobs, and getting that piece of, the American dream that we want for every family.
To your point, we learned that the immigration numbers last year were higher than previously thought. How much of that do you think helps explain this strong job growth month after month, while inflation actually hasn't been accelerating? It's been slowly coming down, and we've had a bit of discrepancies also in that household survey.
Exactly. So the prices have been coming down, right, slowly from their peak, another high priority for the president. And I would say that this is an example of how a strong economy overall is just good for everybody. This labor market has pulled in everyone. And so we're seeing certainly growth for immigrants. So that includes immigrants, that, we're a nation in which growth has often included the contributions of immigrants. But it's not just for the immigrant community. Just like the sectors in which we've seen growth are broad-based, the benefits across different communities have also been really, really broad-based. This last month, the growth for labor force participation rate among prime age workers remained steady, but the overall participation rate went up, and some of that was attributable to more young workers in the labor market.
On immigration, though, how much of that do you think could explain the outperformance we've seen in the economy? And do you expect immigration to continue at this rate? What will that mean for the outlook for the job market and the economy?
So we've certainly seen, immigrants in the labor market help contributing to this growth. We've also seen, for example, the lowest level of gap between the black-white unemployment rate. 2023, the black unemployment rate was also historically low. And so again, when the president says we're going to leave no one behind, he means it. And we're serious about setting up programs in communities all across the country so that everybody can see themselves and participate in this moment of real job growth and opportunity.
With so much real job growth, to your point, if this continues, what does that mean for the outlook for the economy this year? Because so many economists have thought that we'd see a bit of a downshift in growth this year from last year. But looking at these jobs numbers, what could that spell?
That's right. People have been betting against this economy. We come here every month and talk about how, none of what we're talking about here today, the 15.2 million jobs have been created since the president came into office, all of these other indicators, none of them were promised or even predicted, right? In fact, most people said that was not going to be possible, that if you wanted to raise wages, you were going to, you were going to see continued runaway inflation. That has not been the case. Or if you were going to, really build up the number of jobs, you're going to have to increase the unemployment rate. None of those things has happened. And to your first question, that's because the president's policies have really been about let's not just build back from the pandemic, but let's create a stronger economy in which there's widely shared growth, right? This idea that when there is prosperity, it should only go to those at the top, to the few. That is not the president's vision. And so that's what we're seeing now, is that when you invest in working people, that has a virtuous cycle of creating more growth and more opportunity.
So you do expect stronger growth this year, real quick?
I mean, let's just looking back, right? 3 years ago, when the president came into office, the pandemic was raging, right? We were seeing record high skyrocketing unemployment. People were not sure when they went to the store if they would find toilet paper or baby formula. Look at how far we've come just in those 3 years. And so, the numbers don't lie, right? And each month, if you don't take any one month, 303,000 is a terrific number. But if you look at the 3-month average over the last 3 months, it's 276,000. And so this has been just, again, very steady, very stable growth. It is that, coveted soft landing that people also said was not possible. And I would just say, the president had a vision. He brought it with his experience and his knowledge. And we're going to continue to keep on doing what we're doing to build it and to spread it.
Secretary, unfortunately, we are out of time, so we'll have to leave the conversation there. But thank you so much, as always, for your insight. That's Acting Labor Secretary Julie Su. You're watching Yahoo Finance. We will be right back after this.
Apple supplier Foxconn posted a 9.6% revenue dip in the first quarter, but remain confident that revenue will grow the second quarter. The company, which trades as Hanhai Precision Industry in Taiwan, it cites that the early part of the year is traditionally a downtime for the smartphone suppliers. post-holiday season. One of the huge things I think as well is being able to check in on Apple shares and the demand profile that we know for a lot of what the companies have been navigating. We were talking about Samsung earlier. For Apple, they're seeing a move higher of about 0.5%. But I think perhaps it's more focused on how Foxconn is going to deliver for them on the second half of this year, part of the year where they typically have a lot of their larger announcements, especially on the hardware, handset, smartphone, wearables devices as well, typically.
Yeah, we closely track this just because of exactly like you're saying, what this means for Apple, what if this is offering any sort of insight into demand. I think one of the reasons why Apple is also rising with the broader market today is also because Apple shares, it's no secret, have been under a tremendous amount of pressure, have far been an underperformer when you compare it to some of those other Mag 7 names since the start of the year. When you're looking at year-to-date losses, it's in the red. You're still looking at a loss here over the last several days as well. So taking into account that some of that bad news or some of that worry had already been priced in actually over the last 5 days, still up just about 1%, but year-to-date still in the red. Analysts getting a bit more bearish on Apple, at least in the short term. You talk about the fact that we do see falling demand or saturated demand here in the U.S. and then taking a look at what's happening over in China. Obviously, sluggish demand there, rising competition, and then also the fact that the lackluster in terms of excitement surrounding their new products. What is exactly going to take to get iPhone users who currently have an iPhone to upgrade? And there's lots of questions about whether or not this next cycle that we will likely get in the fall, if that will be enough to kind of change some of that momentum. So many more analysts than we had seen over the last several months have been moving to the sideline on this name, Apple. And I think we're seeing some of that lackluster demand reflected in Foxconn's results today.
Yeah, and segment by segment here, specifically one of those segments, and we've been focused in on smartphones here, declined year over year. It blamed actually the high base, so tough comps that they had seen last year when they were really being able to move through some of the orders that they saw come in. And after one of the factories there did see some reopening. That was, of course, chronologically coming after the zero COVID policy, zero tolerance for COVID policy and pandemic disruptions that the industry had seen as well.
All right, well, keep right here on Yahoo Finance because coming up at the top of the hour, Madison Mills will be here at the desk with me as we take a deep dive into that March jobs report. City economist Andrew Hollenhorst will be joining us along with Manpower's Becky Frankwitz. They're both set to weigh in on what exactly this jobs report means for the Fed's timeline of rate cuts.
That's right. Plus, our own Brian Saza going to be at the New York Stock Exchange with Levi CFO Harmeet Singh. You don't want to miss that. I wonder if Saza is going to wear some jorts down there. It's warm enough.
I'm rocking jeans in the studio today.
There you go. Yeah, you got the jean energy. They got a Canadian Tux energy down at the NYSE. We saw that earlier. I'm going to be back in 1 hour's time for wealth. Theme today, future jobs plus 5 things first-time traders need to know before getting started. Going to be a fun one. Trust me.
Welcome back to Yahoo Finance. I'm Madison Mills alongside Shauna Smith. We are 30 minutes into the trading day, and the big news driving market action this morning, of course, that March jobs report. The U.S. adding over 300,000 jobs in March, blowing expectations for this print out of the water. Unemployment ticking a bit lower, showing that the labor market remains on strong footing, but we did see the lowest year-over-year hourly earnings growth since June of 2021.
Yeah, Maddie, that number that you just ended on here, that 4.1% growth, that actually has a lot to do with some of the market action that we're seeing in the early trading days. So let's take a look at the major averages here and some of the movement that we are seeing shortly here at the open. You take a look at the gains almost across the board, or it is across the board for the major averages. You're looking at the Dow up just around 100 points here today on a 5-day basis, still under a bit of pressure. You've got the S&P also under pressure for the week, but today we're looking at gains of just about 0.5%. Same goes here for the NASDAQ, down for the week, but up at just around 0.7% here. So the leader amongst the three major averages. And also taking a look at the bond market. Now, this is really interesting action. We talked about the fact that the equity market here moving higher, a lot of that having to do with the fact that we are seeing the wage growth cool just a bit, but we are seeing yields continue to spike. And this is essentially true here across the board. We're taking a look at the 10-year yield here right now. We're looking at a gain of just around 6 basis points, right at 437. A lot of that has to do with the fact that clearly this jobs report showing signs that maybe the economy is reaccelerating. So that's pushing yields here to the upside. You're also seeing that play out in the 30-year yields. And then also the U.S. dollar index. We want to take a look at that because you have the dollar gaining today up just over 104. So certainly some interesting moves that we're seeing play out in the market today, Maddie.
Well, it's interesting looking at the moves we're seeing in the bond market, mirroring what we're seeing in equities, just kind of up across the board and indicating this kind of growth that we're seeing under the surface of the economy and this kind of idea that the economy is going to be able to withstand a higher for longer rate environment. Having said that, oil may be pouring cold water on that idea. We actually have oil coming off its highs there, but Brent crude hitting and staying over $90 a barrel if we take a look at that. And remember that oil record yesterday is part of what threw cold water on the overall market. That combined with Kashkari's comments leading to a bit of a sell-off and seeing, thank you, Shauna, for pulling up these energy names here, seeing a little bit of a sell-off in the individual names here today. So perhaps indicative of a bit of a slowdown coming in with commodities here.
All right, well, the U.S. added 303,000 jobs in the month of March. Well, that was well above the street's expectations. Now, Citi saying in a recent note that they expected the job market to weaken with just 150,000 jobs added in March, leading to 125 basis points of cuts this year, almost double what the market is currently pricing in. So where do things stand following this higher than expected jobs print that we got out this morning? We want to bring in one of the economists behind that call. You have Andrew Hollenhorst. He's Citi's chief U.S. economist. Andrew, it's great to see you here. So first, just your reaction to the print that we got out this morning and whether or not that changes your base case for the Fed and the degree of the cuts that you are expecting this year.
Yeah, this was a much stronger than expected jobs report. Like you said, stronger than our forecast, stronger than consensus forecasts. I don't know that it changes that much for the Fed at the end of the day, or that we should be changing our forecast at Citi, and I'll explain why. From the Fed's perspective, this is exactly the kind of jobs report that they want to see. Like you explained, very strong job growth, but not a pickup in inflationary pressure to the extent that it would concern Fed officials. What we've seen from the Fed recently is a real tolerance for somewhat stronger wage growth, somewhat stronger price growth. To your point, year-on-year inflation readings, year-on-year wage growth readings are coming down. That's going to keep the Fed encouraged that we can actually run this stronger job growth, and it's not going to lead to a reacceleration in inflation. Now, is that something they should be worried about? I think they should be. But if you've listened to the recent Fed rhetoric, they're really pushing a narrative that the potential of the U.S. economy is greater and that potential job growth is higher so that you can have these jobs numbers and you can still have the Fed on course to cut rates later this year. We haven't heard from Fed officials after the report. I think when we do, what we'll hear is that they still think they're on that path to cuts.
Well, you bring up an interesting point that Mohamed El-Erian kind of mentioned this morning, saying that the Fed is sort of acting like, I'm extrapolating here, but like a sports commentator. They're just commenting on the data as it comes in. They don't have this central thesis driving them. But it sounds like you might be picking up on some sort of central thesis from them that you might disagree with. Can you spell that out for me a bit more?
Yeah, I think where the Fed has been, and I would agree with Mohamed El-Erian on this, is that the Fed has been very, very reactive to each data point. And that kind of happened throughout 2022, even into 2023, as the inflation readings just kept coming in stronger than expected. And what they're trying to shift to now, I think, is a kind of consensus around the idea that, in their view, interest rates are restrictive at these levels. And if they don't begin bringing down interest rates, that will slow the economy later in the future. So they need to start bringing in interest rates down now to prevent that slowing that could happen in the future. I think that's where they are as a committee. But there are two risks to that, like you point out. One risk is that you cut rates too early and that reaccelerates inflation. And we have a lot of signs that inflation is really not getting back to 2%. It looks a lot stickier around 3%. There's also a risk to the other side of the mandate, the employment side of the mandate. Now, you're certainly not seeing it in the jobs figures today. Very strong hiring, a low unemployment rate. But when you look at some of this data in detail, you see things like the unemployment rate that, yes, it's low, but it's risen almost half a percentage point. And when you get this kind of gentle slowing in the labor market, especially when you might have some labor hoarding that's going on, people had trouble hiring, so they're reluctant to fire now. Firms are reluctant to engage in those layoffs. You can have a quick shift towards layoffs. So you really want to be careful with this labor market data. Yes, in terms of where we are today, very strong. In terms of where we're going, there's still a lot of open questions.
Andrew, if the Fed does not cut 3 times or cut what your base case is 125 basis points of cuts here before the end of the year, what is that then? Talk to us just about the risk that that poses to the economy, the likelihood of a recession, the weakness that we could see in the jobs market, and then further what that would tell us just about the overall pressure for the U.S. economy going forward.
Well, this is what's so difficult for Fed officials to manage is you do have these long and variable lags, is the term that always gets used, in terms of the effect of monetary policy on the economy. So interest rates are high. They've been high for some time. Inflation has come down, which means real interest rates have actually increased. That is exerting more and more of a restrictive power on the economy. At some point, that is going to slow the economy down. If you just leave interest rates at a restrictive level for too long, then you will slow the economy perhaps more than what's necessary to bring down inflation. On the other hand, if you look at the data today, well, the activity data are all holding up, jobs data is holding up, and inflation is running above target. So, just based on kind of the data that we got this morning, for instance, you would say, why cut interest rates? There should be no rush to cut interest rates. But if you think about where we might be going, then that creates an argument for cutting interest rates. And the Fed is trying to get that balance exactly right. That's their job. That's, of course, what they're going to try to do. The reality is that historically, central banks do not get that balance right. Sometimes it's impossible to get that balance right. It may be that there is no path to 2% inflation that doesn't involve unemployment going higher.
So this brings up a really difficult point then about how challenging this is for the Federal Reserve. And we've been talking about how the road to 2% would get harder as it went along. And Jay Powell certainly talked about that as well. But given what you just mentioned, is there a reason for them to cut with inflation still looking hotter than expected and this jobs print as of this morning?
Yeah, so I mean, if you look at the most recent data on inflation, it really hasn't been encouraging of this idea that inflation had just slowed down. At the end of last year, that story looked a lot more encouraging, where you had 6-month core PCE, and I think there was maybe a little bit too much emphasis on that one measure. That had gotten down below 2%, and Fed officials were looking at that, and I think they were really thinking, maybe we really have the soft landing here. Maybe we don't want to say it publicly, but maybe we've kind of really achieved that. And now it's just a question of kind of, when do we actually get these cuts going? If we've landed the economy softly, then we can start to normalize interest rates. There's a much bigger question now about whether inflation is really coming down. I think it has become a lot more clear to markets, to Fed officials, to analysts, that there is a last mile problem here, that it will be difficult to bring inflation down. And by the Fed's own forecast, they have inflation closer to 3% at the end of this year than to 2%, at least on a core PCE basis. Yet they still plan to cut in that scenario. And that's this difficult balance between supporting employment, but also trying to be attentive to your price stability target.
Yeah, and Andrew, speaking a little bit more about that last mile in terms of taming inflation, you've got wage growth, yes, improved a bit when you talk about that drop from what we saw the previous month, but still strong. You've got oil prices. Maddie was just discussing this massive move up that we've seen in crude and Brent. Is that going, do you think, to contribute to the difficulty here for the Fed in trying to tame inflation and almost keep inflation moving sideways here for some time?
Yeah, what we're seeing with goods inflation, with oil prices, that could be a real headache for Fed officials. The way we got down to that 2% inflation on a 6-month basis where we were at the end of last year was largely through goods price disinflation. And now that we're starting to see some of these potential supply chain disruptions again, and just this move higher in energy prices that we've seen most recently, we shouldn't expect that disinflation to continue. And if anything, you could have some upside risk to goods. And on the other hand, the domestically determined inflation, particularly in the non-shelter services, that's going to be very responsive to wages. And I think you described the data exactly correctly there, that yes, wage growth has slowed, but wage growth is still running stronger than it did pre-pandemic. Of course, wage growth is a good thing for employees. The issue is when that wage growth feeds into higher prices from firms, and you're kind of stuck in the scenario where wages are running higher and prices are running higher also. And that's where we are right now.
Sounds like not a lot of reason to cut other than the Fed already telling us that they were going to, Andrew. Thank you so much for joining us. Really appreciate it. That was Andrew Hollenhorst, Citi Chief U.S. Economist on all things jobs, data, and more. Now we're going to move over to some company news because Apple cut over 600 jobs in California. That's according to a state filing. And the filing did not specify what sector the cuts are in, but experts are speculating that is related to the company abandoning their long-running project to build an electric self-driving car. And Shauna, what I think is particularly interesting about this is that these are notices that are filed with the state of California. So we know right now that it's 600 jobs, but it could be significantly more, given that some employees could be in other places of the country, of course, and we're anticipating that this is, again, related to Project Titan, the CARS project, but also the display project as well that they were working on. So curious to see how this number kind of develops long-term and what the scope of it is.
Yeah, and I think when we initially got this news that Apple was abandoning its EV car plans, a lot of the thought there was some of those workers were then going to be moved and used for their AI initiatives and their interest in research within that department. But the layoffs, I think, for Apple also brings up the fact of a trend that we've seen since the start of the year. We have certainly seen a number of these larger tech companies announce layoffs. Actually, when you take a look at the tech sector, that sector accounted for the largest portion of job cuts of any of the major sectors here in Q1. So I think the question a lot of people are asking, we talk about the resilience overall of the labor market, is whether or not some of that trend that we saw in terms of trimming headcount in the first quarter, specifically within the tech sector, whether or not we are going to see a further contraction within tech, within employee headcount, or if we're going to start to see a shift, if it's leveled out just a bit. We were talking to one of LinkedIn's economists earlier in last hour, and he was talking about the fact that he does expect that to level off just a bit, that tech companies are hiring once again, and hiring has increased just a bit, or interest to hire has increased a little bit on their platform. But when you've got a big name like Apple that is cutting jobs here, it's grabbing the attention, it's refocusing some of its focus here in terms of the AI initiatives, it's going to make investors think twice just about what some of those longer term goals are here for the company.
Yeah, and you have to wonder, I mean, at least anecdotally, I feel like I know a lot of people in tech who've suffered layoffs or just pullbacks in the industry. So curious to see if there's some of that recovery moving forward here. Now, coming up, is AI coming for your job? As we were just discussing, potentially it is. We're going to break down how artificial intelligence is impacting the overall job sector. That's coming up right after the break. As artificial intelligence continues to dominate the tech industry, debates are growing over how it will affect workers and the economy, and just how in demand those jobs will be. Just this week, Tesla CEO Elon Musk weighing in on the demand for AI jobs on X, saying, quote, "The talent war for AI is the craziest talent war I've seen." So to break it all down, we're joined by Becky Frankowitz, Manpower North America President and Chief Commercial Officer. And Becky, it's great to speak with you again. Thank you so much for joining us. Looking at the jobs print from today, not seeing a lot of AI taking jobs away from people data there, but I know that in your role at Manpower, you do a lot of recruiting, you see a lot of data when it comes to the jobs market. So I'm curious, what impact have you seen AI have on the jobs market, if any, and did any of that have a read-through on the number that we saw today?
Yes, first I'd say overall tech demand, which you talked about in the prior segment, continues to be strong. Software developers are the number 2 most in-demand role in the country today. General IT is number 4, so 2 of the top 5 are in the tech space. And if you dig into AI machine learning engineers actually continue to hit record highs month over month. So the first question is, okay, what is an AI machine learning engineer? They're the people who write the algorithms, who do the back part of the mathematical equation, and they also do the consumer interface that you and I can log into ChatGPT and actually be able to type something in as an example. Within that, so that's a growing space. Now, to your point, did it show up in the numbers? Not quite yet, because what we're seeing is companies starting to make that investment into the tech space for AI machine learning, but we're seeing that start to ramp. So it's a little hidden in the numbers in the IT demand, but absolutely it is an area to watch as we go forward in terms of the tech space.
Becky, I'm curious, what are you hearing from companies here? Because like Maddie just referenced here in that intro with Elon Musk posting on X that he's actually having to boost pay in order to attract the workers that he needs right now, the AI engineers. Is that consistent with what you're seeing, that there's simply just a shortage of workers that have this skill set that's very valuable to so many of these larger tech companies, and not even just tech? It's really a skill set that many companies within various industries are seeking at this point.
Yeah, Sean, a great point, because the first statement I would make is all companies are tech companies. The number 1 employer that is hiring in the AI space today is Capital One. So it's not the big tech companies that would come to mind. So all companies are tech companies. But I think the bigger problem, so yes, Elon Musk can increase wages to attract talent, but the bigger challenge is we don't have enough people with those skills. So they didn't exist before. These are jobs that have never been created. So we're having to upskill and reskill people with adjacent skills, which I actually think is a good thing, because it helps us onboard people on ramps into tech. It makes tech more accessible, which I have a passion point around specifically for women. And also within tech, there's more accessible roles than AI engineers. There's a role called a prompt engineer. And it sounds fancy, but they're basically the people that write in human language to the computer so it can output what we want to understand. Again, using a ChatGPT example on my own, I have 3 daughters and I say, okay, what are 10 dinner questions to ask your kids, your teenage kids over dinner? It's that kind of human language, very accessible, no coding experience necessary.
So I'm curious then, Becky, in the jobs print from today, we saw that labor force participation rose to 62.7%. To what extent is the dynamic that you're talking about with this reskilling and additional job demand feeding into that overall labor participation number, or is that coming from some other sector or area?
Yeah, so I like to put numbers around things because percentages guys some truth. First, what does that percentage increase, 0.2 point increase mean? 334,000 new Americans joined the workforce, 334,000, which is a great, great number. 2 things that I would say concern me in the number. We saw women's participation tick down just a bit for the first time in 4 months. So I'm worried about that. But the one that's more concerning that gets to your question is for people without high school degrees. So non-high school graduates went down in participation by 2 percentage points. So that is something we have to keep an eye on, because think about on-ramps to employment. As tech grows, we can't have a generation left behind or a group of people left behind. And so what we saw increase is prime age workers, which is good to see. But we saw a few places that I'm going to be watching, because we're going to need everyone. And I know your opening started with, is AI going to take our jobs? Well, guess what? We need AI to take some of the tasks within our jobs, because the population isn't growing at a rate that will support economic growth. and we're losing retirees. Some have come back, many more are exiting the workforce. So we need some tasks to be automated so that America can have economic growth. And so we need humans and automation to work hand in hand. So we're going to continue to see that demand for both skills, but also for human beings to enter the workforce. So I was very pleased by the expansion and participation.
And the boost ultimately that AI could add here to productivity. All right, Becky Frankowitz, always great to speak with you. Manpower's North America president. Thanks so much. Let's take a look at Uber. It's a trending ticker here at Yahoo Finance. Jefferies raising its price target on the stock today to $100 a share. That's up from 95. Now the firm citing Uber's expanded mobility product offerings and faster bookings growth as some of the reasons for the raise that they just put out here for their price target. And more specifically, they talked about the fact that there was just 2 mobility products available at Uber back in 2011. So just around 13 years ago. Compare that to today, where they have just around 20 current mobility products that they are offering. So further expansion. At least Jefferies is making the point here, Maddie, that that's going to help Uber really maintain that competitive edge that they do have over Lyft right now as its only real competitor within this space. And that ultimately, if you capitalize on these products, it should drive frequency in terms of users. It should also open up their user base to hopefully increase that a bit more, and then ultimately pay off for Uber down the line.
Absolutely. Well, it's interesting to note that not only have they increased their offerings, they've also upped a lot of their partnerships. As we've been discussing, we have, for example, Uber Eats partnering with Waymo, this autonomous car company that's based out in California as well. They're going to be launching in Phoenix for autonomous deliveries. That is obviously a huge deal potentially moving forward in the future, right? We also have, of course, Uber Eats. We have JetBlue working on a deal with Uber. I'm also separately working on a story about air taxi companies partnering with Uber to potentially get an Uber to take you to your air taxi that would fly you off to JFK in under 7 minutes. So seeing them have the now profitability and cash flow on hand to be able to invest in other companies and potential partnerships that could grow the business even further.
Yeah, certainly. I mean, it's paid off so far, and just in terms of the market share and how big of a lead they have against Uber. And you talk about some of those very innovative initiatives that are taking place at Uber, and that's going to help them really carve out that moat that's so important within their ride-sharing space right now.
And especially, I feel like because we are now in this kind of non-free money environment, seeing them be able to succeed is an even bigger deal, because for so long, at least my go-to talking point for Uber was, oh, they're not profitable yet, but now they are. And so given that money is expensive now, that's kind of a little bit bigger of a deal. So coming up, we're going to move on to Levi's. We're going to dive into Levi's quarterly results with CFO Harmeet Singh. That's coming up on the other side of this break.
Teladoc announcing today that its CEO Jason Gorvich will be stepping down effective immediately. Now, the company's stock has been under pressure. You can see the reaction actually still negative here today, off just about 0.7%. But since the start of the year, we've been down about 30%. Down about 95% from its all-time high back in February of 2021. Here with the latest at Yahoo Finance's Anjali Kamlani. Anj.
That's right, Shauna. And as you mentioned, off of its highs from 2021, we know that was right in the middle of the pandemic, which is the reason why you see the stock under pressure right now. Telehealth in general has become so largely commoditized, and there's a lot of competition out there for Teladoc now. So it's really running up against all of that. Meanwhile, we know that Jason was at the helm of the company for more than 15 years rather. The company, despite this news, is reiterating its guidance for the year, does have $1 billion cash on hand, so they are in a strong financial position. And CFO Mala Murthy is taking over as interim CEO for right now. She did say in a letter that Yahoo Finance took a look at to employees that during the transition period, her focus will be on ensuring the company continues to operate effectively and delivers on commitments to clients and members. So looking at not disrupting the workflow yet, and the company did announce they're looking outside to replace Jason.
Well, Anjali, Johnson & Johnson also agreed to purchase Shockwave Medical this morning for $12.5 billion. I know you know a lot of the details of this deal. Talk us through it.
Yeah, the deal itself wasn't surprising, but it is quite a large deal. We know that it ranks up there among the deals for the year. I would hesitate to say the largest, but it is a good cardiology play for Johnson & Johnson, especially for its med tech line of business. We know that medical devices, strong suit cardiology also for Johnson & Johnson, especially after it spun off its consumer space. It has been looking at, really beefing up the pharma side as well as the med tech side. And that med tech side has been kind of a slow growth area for the company in the last few years. So this could really boost what the company has to offer. This deal really something that investors are excited about. So letter of intent out right now and should close this year.
All right, Anj, thanks so much for that. Let's take a look at crypto, because the crypto trade on the move this morning. Bitcoin holding above $66,000, nearing just shy of those record highs. Some investors may be a bit concerned, though, that the rally has stalled just a bit at these levels, now above 67,000. So what's next for crypto? Yahoo Finance's Jared Blicker here to break it all down. Jared, give us the tea.
Yes, Shauna, what I want to highlight here is Bitcoin is green, just barely. It's up a whopping 4 basis points, but Ethereum in the upper right, that is down 2.34%. And I want to show you what's happened over the last week. You'll see Bitcoin is down 3%, Ethereum is down 6%. So Ethereum is down twice as much as Bitcoin. And there are people who track the ratio of Ethereum to Bitcoin, and that chart is actually at a level which is kind of raising a lot of eyebrows. So you can, in technical analysis, have something called a golden cross or a death cross. A death cross is when a short-term moving average, the 50, passes below the 200, and all it is a long-term trend indicator. All it indicates is that the existing state of affairs may continue into the future. So the concern is that if Bitcoin is outperforming by a wide margin Ethereum a proxy for the altcoins, that there's just not as interest as much in crypto anymore as a whole. And Bitcoin, being the leader in the group, is expected to retain its value as the others sell off. So let me sort this by performance, and I can illustrate it this way. You can see in the lower, we got FTT token that's down 13.5%, Dogecoin down 13%. Arguably, those are the most speculative, some of the most speculative tokens, at least on this list. And you can see that they are underperforming by a wide margin. I noticed that coming into the year, that was a similar state of affairs. That was before the Bitcoin rally took off. So is this an indication of Bitcoin FOMO or fear aversion? I'm a little bit leaning to the left there, or to the latter there. I think it's a little bit of a disconcertion in the market right now, especially given some of the macro data that we're in, or that we've gotten, especially that hotter than expected payrolls report this morning. So we'll have to see if this continues, but pay close attention to the ratio of Bitcoin to Ethereum here, guys.
All right, Jared, thank you so much. We're just complimenting your sneakers over in the studio. So hopefully we can get a little bit of a... I know, we got to pan down to get the Nikes. Thank you so much, Jared. Really appreciate it, as always. Well, traders are hugging Levi's stock like Beyonce hugs a pair of Levi's jeans, thanks to our own Brian Sozzi for that line. Levi's shares surging 12% on earnings day this week. That's due to a better than expected quarter. But what traders are really banking on is this Beyonce boost to Levi's this spring. Yahoo Finance Finance executive editor Brian Sozzi is down at the New York Stock Exchange with Levi's Chief Financial and Growth Officer Harmeet Singh. Brian?
Hey, Madison, that's one hell of an intro. Really, really well done. But yes, Harmeet, always good to see you. And if I picked up on anything, a lot of activity, as you can see down at the New York Stock Exchange, really takes me back to your IPO over 5 years ago?
Exactly 5 years.
Exactly 5 years. Nonetheless, in your latest earnings report, to me, there was a lot of new trends called out. And I think that's very important for investors to know what these trends are because they will shape your earnings. Maybe you could tell us a little bit about them.
Sure, so denim is having a moment, and the brand's never been stronger. And we, as a leader, are leading those trends. So it's really more of a head-to-toe look on denim on denim. And as a company, we're evolving into more of a denim lifestyle apparel retailer. And so what are the trends? Our core is solid. 501 grew 20-odd% on top of 30% last year. But what's really happening is there is the looser, baggier fit that's taking shape, right? Our men's and bottoms.
Hey, this ain't for me. I want to look slim, Harmeet. It's not for me. Maybe it's for you.
I wore my first 5'1", 5'17" boot cut the other day. And so if I can do it, you can do it.
I did that in high school in the 90s. All right, go ahead.
But, the looser baggy fit is really what's taking off, and that's important. Our core is still very solid. The other thing is, we're introducing dresses, we're introducing denim skirts, we're getting into jumpsuits, and that is up triple digit. And that's a larger addressable market. So, as we evolve the brand into more of a lifestyle apparel, a denim brand, addressable market is increasing. The other thing that I'll ask you to go and check out is with the growth in the active apparel market, we've introduced performance tech. So that's available for $69.50. I wear all the 6 colors, and so it's for you, Brian.
Talk to us about what you think is driving this moment for denim. I walk around, I still see people wearing jogging pants and various jogger type of pants, but why do you think people are navigating to what you're selling?
Yeah, it started post-COVID with the world becoming a lot more casual, dressing becoming a lot more casual. And denim, how can you be more casual other than wearing good style denim products? And the other piece is people want to be comfortable. And that's where the looser, baggier fit is really taking shape. And so the question is, can you wear more than just denim bottoms? That's where we're introducing denim skirts, we're introducing denim dresses, and that's taking off. So it's all about being more casual. The workplace is a lot more hybrid than it has been in the past. And that trend we're seeing around the world. Our view is that the category, which is stabilized in the US after many quarters of being volatile, will grow about mid-single digit for years to come. And as the brand leader, as the market leader, we've just, we talked about growing our share in men's and women's. And so our job is to be responsible and try and, grow the business from $6.5 billion to $9 to $10 billion over time.
I bet that you have been up around the clock asking your teams about the sales spike from Beyonce. Tell it to us. Give it to us straight. What type of spike you're seeing? Does a spike even exist?
So it's happened, and it's happened organically. There's no better person who's what we call, the center of culture, the cultural czar than somebody like Beyonce. And having called us out, her songs gathering momentum, so far, I think last couple of days, recorded 1.5 billion impressions, thanks to her being a wonderful fan of Levi's. Now, there's a story. In 2019, she got on stage in Coachella with our, denim cutout shorts, and shorts took off. And so I think we'll see the positive impact on the business, but we are humble and honored that she chose us to, to talk about our brand. And so, again, what's happening is there is also an uplift of the Western, dress culture, the Western shirts, the Western dresses, and which better brand to take that forward other than Levi's?
Well, you mentioned this happened very organically, but as a management team, do you sit around the table and think, let's give Beyonce a call, let's develop our own line of Beyonce jeans?
We have, one of the hidden assets is something we call House of Strauss. It's in key cities around the world. We have one in LA. That team works organically with a bunch of celebrities. And, and that's why you see celebrities. Bad Bunny was up on stage at the Grammys wearing our product. You've seen that happen organically around the world. And so we have these deep relationships. They come to bear, but we do it in a very authentic way because, that's who we are. right, as a company.
It's not lost on a lot of folks watching this right now. Naturally, this is jobs day. 303,000 headline jobs created, another strong month for job creation. What does hiring look like for Levi's? Are you able to get the workers you need in what appears to be a tight labor market when nobody really expected it to stay this tight?
Yeah, no. So we unfortunately, we had to tighten our costs because business was tough about a year ago. We actually just completed a reduction in force, but we are hiring on a targeted basis. As a DDC first company, we are building 100 stores a year on a system basis. So we're hiring for those stores. And so where we're investing is really store associates, stylists, etc. And yes, we are able to get them. Largely because the brand's really trusted, people love the brand, and our business in DDC is really doing well. So to your question, targeted hiring, and is largely happening at the DDC business as that grows.
Since we last talked, Harmeet, and before we let you go, we've seen oil prices really climb here, now breaking through $90 a barrel. What is this doing to shipping rates, and how do you think this might impact products that you may ship towards the back half of the year, like for back to school?
Yeah, no, it's a good question. We watch that. Where our costs really get impacted is driven by commodities, largely cotton. In terms of shipping rates, we have long-term contracts. So at this moment, we're not seeing any pressure in terms of where oil is. Should it rise further, we'll be able to manage through it, because we have other areas of opportunity to try and manage SG&A. But right now, we're not worried about it.
All right, Harmeet, always good to see you. I should say about 5.5 years ago, you had your IPO. Yahoo Finance talked to you then. 5.5 years later, it's good to see you again. We appreciate you always giving us some time.
No, thanks, Brian, for having us. We've been with Yahoo Finance every quarter as we report earnings, and we appreciate it. I know you're now an executive producer. We appreciate you coming to the floor and having this moment. But 5 years, a lot has changed, but a lot has not changed either.
Well, you still look great, and I'm starting to look old as AF. All right, Madison, back to you. Over there in our New York City studios. Hope I got enough Beyonce questions in for you.
You did so much more than I could have ever asked for, Brian. Thank you so much, as always, for bringing us such great content. Our executive editor there, Brian Sazi. We're going to have all of your markets action ahead, so stay tuned for more. You're watching Yahoo Finance.
Jobs in the manufacturing sector has largely remained flat in the first 3 months of the year. But now recent headlines surrounding electric vehicles pointing to a slowdown when it comes to manufacturing in that sector, certainly surrounding demand, with many companies pausing production in the face of slowing demand. But the Department of Energy saying that their projections for job growth tied to EVs remains largely intact. Kiko Fujita has been digging through some of these numbers for us this morning. Hey, Kiko.
Good morning to you, Shauna. Yeah, when we're talking about EV jobs, it's not just about EV production, the vehicle production, but also about battery production as well as EV infrastructure. We're talking about chargers and all the parts tied to that. Now, as you pointed out, when you consider the announcements that we've gotten on layoffs over the last several months, it's hard to definitively say how many of those job losses have offset the gains that we have seen coming through from this accelerated transition to going electric. But I've been digging through some of these numbers based on data sets that are out there. Now, this is a number that's coming through from the Atlas Public Policy. It's put out by the nonprofit group Bloom Green Alliance. They point to 228,000 jobs created. This is largely from the ramp up that we have seen since roughly 2019. EV investments coming through at $176 billion. And then if you're wondering about where the salary stands on that, 11% of those announcements coming through from unionized facilities. That's a cumulative number, and largely you could argue a little more conservative than the estimate that's been put out by the Department of Energy. In its most recent economic report, they pointed to clean energy vehicles creating roughly 38,200 jobs, and that is in 2022 alone. We're looking to get an update in several months on that front. Having said that, you guys have been reporting on this. The last 6 months of the year, the sector has seen a slew of layoffs. You had Rivian laying off roughly 900 employees so far this year, Fisker laying off 15% of the workforce, and then Lucid cutting 7% of its staff. Now, DOE's spokesperson tells me their projections that they have put out still remain largely intact, and they're talking about 130,000 jobs projected to be created as a result of the incentives that they have put in place through the Inflation Reduction Act as well as Bipartisan Infrastructure Act. That's specifically, we're talking about 130,000 new jobs, roughly, with 80,000 in battery manufacturing as well as 50,000 in EVs, components, and chargers. So guys, a fast-moving target here, if you will, just given the slew of announcements that we have continued to hear from these car makers.
All right, Akiko, thank you so much, as always, for bringing us that fantastic report. Really appreciate it. Moving on to stocks, because they are higher on the back of another hot jobs report. The U.S. economy adding 303,000 jobs in March, well above the 214,000 economists polled by Bloomberg that they were expecting that to handle on that print. For more on this, we're going to turn to Drew Mattis, MetLife Investment Management Chief Market Strategist. We also have Skylar Montgomery Koning, TS Lombard Senior Global Macro Strategist. And thank you both for being here. Drew, I'm going to start with you because we are seeing that the market is ripping off of this hotter than expected jobs print this morning, reversing yesterday's sell-off. I've covered previous jobs reports we all have where the same data led to another round of a sell-off. So what is it that's leading to this market action today?
Well, I think it's the strong report, no inflation, any concerns people had about a declining work week, the composition of labor, the gap between kind of the unemployment rate survey and the payroll survey. All of those were basically in sync today. So everything's moving in the same direction, and it's moving in a direction the Fed would want to move it in. And so people are excited by that.
Drew, when it comes to some of the other aspects of this, just in terms of the fact that we had seen some pressure heading into this print, the fact that the S&P is still on track, we could see the worst week of declines since the start of the year. How much of that concern do you think has already been priced into the market at this point?
Oh, well, I mean, markets are priced for really good news, right, across the spectrum of different asset classes. And so, I hesitate to say everything's been priced in because everyone always talks about everything being priced in, and yet the market still moves on events. And so, I do think we're heading into a period of more economic volatility. But, I think it's pretty clear from this report that things are pretty good in the U.S. economy right now.
Skylar, I want to bring you in here. Was this jobs print a Goldilocks number for stocks?
I think, the broad answer is yes. So if you think about the equity market, there are two main drivers. Those drivers are the policy outlook and the growth outlook. Now, the market focus last year was definitely entirely on policy, but because the market knows the next move is a cut, the focus is shift back to growth. So now we're in an environment where good news is good news once again. And the US economy is strong. We've had economic surprises as positive, despite upward revisions to consensus, and growth is above trend. We're also seeing more signs of a catch up in the rest of the world. So we're getting more optimistic on global growth. And that economic optimism can feed into equity markets. And so, I think while it's been more of a Goldilocks print in terms of the non-farm payrolls report we've gotten today, I don't think we necessarily need inflation to come down significantly to have strong equity markets if that inflation is driven by the demand side.
Skylar, how do you think this report is going to shape the Fed's narrative and then ultimately what that means for equities?
Yeah, I think the Fed continues to be data dependent, and that data dependence is running into a problem in the inflation outlook in terms of that inflation outlook isn't allowing them to be as dovish as they were previously. We had a year of downside surprises in inflation in 2023. We've now had 2 months of upside surprises in inflation. Our view is that disinflation continues into the end of the year and that, we see a revealed preference from the Fed that they can allow higher inflation and they cut eventually. The problem is right now, growth is still strong as shown by the NFP report, and it's much harder to cut after 2 upside inflation surprise months, let alone if we get a third next week, than it was after a year of downside inflation surprises.
Well, Drew, I want to go back to you then, because I guess the area where I'm getting confused is a lot of the talking points that we're hearing right now are the same things that we were saying when we thought, oh no, the Fed is going to have to cut, there's too much strength in the market. So just explain to me how we're able to kind of use the same data points and the same kind of thesis on what this economy is looking like to justify what the Fed is going to do next, given what we've all thought previously.
Well, I think it's really, we're talking about kind of how is the Fed going to respond to a certain piece of data. And, inflation's likely to be sticky, and the inflation surprises have been higher. And, as we head into the summer, we have things like higher gas prices to look forward to. We have the potential for higher food prices related to bird flu and the like. So we do have this potential for inflation expectations to become somewhat unhinged. However, I think today what people are really focused on is the wage story. Wages came in kind of as expected with a slight deceleration in activity. And people are then really kind of looking ahead and projecting that forward. When the reality of it is, as I said earlier, there's going to be more economic volatility going forward. Inflation's not going to move in a straight line. Even people who believe it's going to actually improve, i.e. go down over the course of the year, are not saying it's going to go down in a straight line. And I think we're going to have to get used to inflation expectations maneuvering around a bit, and inflation expectations, which are going to really be driven by food and energy prices, which the Fed says they ignore, but which drive inflation expectations. They have the potential to drive Fed policy going forward in terms of either limiting or increasing the number of rate cuts that we can expect.
Skylar, when it comes to positioning what investors should be doing right now, what are some of the changes, if any, that you have made recently? And what do you expect to lead a next leg higher if we do see some resilience in the markets?
Yeah, it's been really interesting, actually, kind of rotation we've seen under the surface. I think U.S. equities and tech in particular, they've actually lagged other markets in 2024. And I think it shows some hesitancy around the momentum that we were seeing in tech. U.S. valuations are expensive and they are higher than a lot of the other markets. It's in part justified because you have profit margins in the U.S. that are very strong. Consumers aren't pushing back against prices as much as they are elsewhere. And you're also seeing sales and earnings growth that are quite strong as well. But that doesn't entirely explain the premium. And so we see kind of this continued rotation away from the overbought, overvalued markets like the US. And so slowly we've been moving away from the US into Europe. But then also under the surface, you can see kind of more of those undervalued sectors coming to the forefront, or cyclicals as well, now that you've got more optimism on global growth.
All right, we have to leave it there. Drew Mattis of MetLife Investment Management, Chief Market Strategist, as well as Skylar Montgomery-Koenig, T.S. Lombard, a Senior Global Macro Strategist. Thank you both for joining us here this morning. We'll keep right here on Yahoo Finance. We've got much more of your market action ahead. Again, you're still looking at gains across the board. The Dow now up over 200. We'll be right back. We want to bring you some breaking news. A magnitude 4.7 earthquake struck New York City's surrounding suburbs in New Jersey just minutes ago. Now, New York Governor Kathy Hochul in a tweet saying that, quote, "My team is assessing impacts and any damage that may have occurred, and we will update the public throughout the day." Now, the epicenter of the quake was detected about 4.5 miles northeast of White House Station in New Jersey. Now, this is according to the U.S. Geological Survey. And for people not familiar with New Jersey, it's central New Jersey, slightly north here. Now, the last time a relatively big earthquake shook the East Coast was in 2011 in Virginia. Now, we have video here of us in the studio just minutes ago, and if you watch closely, you can see the effect, a bit of the camera shake. I'm mid-talking. I don't even feel it. Maddie, you're looking at me like, aren't you feeling what is happening right now? But again, we were talking to our colleagues here at Yahoo Finance, others that are in the building, and they certainly did feel the shake here of the earthquake. They felt it clearly on the floor. I somehow missed it. I can't believe I missed it. Maybe I was just too enthralled with what I was saying.
You were locked into the Uber stock.
It was certainly, though, it's something that I think a lot of people, when it happened, were second guessing because of the fact, like we just said, it's been quite some time since we have felt an earthquake here on the East Coast.
Well, in New York City, too, you never know. You said it. Is it construction? What's going on here? So it was the earthquake, hoping that everyone is feeling safe this morning. But that's going to be all from us for now. Coming up, we've got our new show, Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith has you for the next hour, so stay tuned for more.
Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. On today's show, is the AI boom stealing jobs or creating them? We speak to an academic on the growing role of business schools. And a graphic novel about finance? It might be time to change the way you think about the almighty dollar. Plus, jumping ship, why those of us moving jobs could be set for the big bucks. Let's get this bread. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Your wealth theme for today, future jobs. Why AI might be coming to a business school near you, and why jumping ship might be the best way to get that pay raise. All that and much more during today's show. So, let's talk jobs. The March jobs report was released Friday and tells us the American labor market is holding up well, and that's the emergency alert for our 4.7 magnitude earthquake. All that aside, maybe too well the employment situation holding up for the Fed to cut rates just yet here. Leisure and hospitality employment is trending up, but there are two other sectors with a ton of demand right now, construction and healthcare. Construction adding 39,000 jobs in March, healthcare adding 72,000. Joining us now for a deep dive on both, we've got Yahoo Finance's Danny Romero and Angelique Emlani standing by. Let's start with you, Danny.
Brad, good news. The construction sector added 39,000 jobs in March, but that's not enough to fulfill all of the demand out there. Data from the Associated Builders and Contractors found in January that the industry needs more than 500,000 workers this year to keep up with projects. And companies are trying to staff up. In the latest government data, non-residential building gained over 2,000 jobs, while residential construction jobs increased by about 5,000 in March. But this industry is struggling to find workers. Other government data shows that in this sector, there were over 440,000 job openings in February. That's an increase from January's level. And we can't forget about wages. That hasn't slowed down. Over the last 2 years, construction pay has increased over 5%. And a final point. If you're a construction worker looking for a job, you'll find one. There's plenty of opportunity and hiring isn't slowing down. So let's shift over to healthcare. What's the latest on that front, Anjali?
Well, Danny, same problem, but different solution. Healthcare numbers, a whopping 72,000 per month for the last month. A conflicting trend in the industry, even as it remains a national leader for job gains. The jobs reported this Friday, much higher than the 67,000 last month. And healthcare has remained and maintains this lead in the past few years, returning to pre-pandemic levels, largely due to compounding problems of burnout and shortages. And that's the reason why, while there is opportunity for areas like telehealth, health tech startups, insurers, those are areas where young doctors are really bypassing the grueling schedule of a full-time clinical job and are getting into these spaces that aren't being tracked by these numbers. Meanwhile, that's fueling concerns for a predicted nationwide shortage of physicians. So what the jobs report told us today was that outpatient care, hospitals, nursing homes, those areas where we know match the population growth of the country, that's where the gains are, and that's where patients are needing the care right now. So those are the things that we see the opportunity for. The payout also good. Average pay for healthcare workers is now more than $77,000 according to the Bureau, and that's higher than the national average for the country. The upper limit can, of course, we know, get into the six figures for specialists like surgeons, but the major downside is the reason why this high demand can't be filled quickly. It takes almost 10 years of studying and a lot of debt to get into this area. So state and federal governments are looking for ways around that to hire alternate sources for some of these jobs and help manage the burden that healthcare facilities are facing today. Nurses, for example, earning well above the national average and are being looked at to shoulder more responsibility. So it's a really interesting scenario there where demand and supply are really mismatched.
All right, thank you so much, Anjali and Danny, for breaking down those two key sectors in this report. We're going to go further down the line in that conversation here as well. The jobs report is more than just a headline number. There's the household survey, the establishment survey, the jobless rate, and of course, wage growth. Over the past 12 months, average hourly earnings have increased by 4.1%. For many economists and market strategists, this metric often seems to be a show stealer. But why, you might be asking yourself? And what is it telling us? Joining us now, we've got Ross Mack, personal finance expert, founder of Maconomics as well. Ross, why should people be focusing in on this wage year-over-year number? It came in at 4.1%.
Yeah, I will say one, Brad, thanks for having me. I think we have to understand, right? It's a very interesting, delicate equation, right? The dichotomy between wages and inflation, right? So on paper, when we see wages increase, I think it looks great. However, we have to understand that it's a double-edged sword. Sometimes there's an unintended consequence when it comes to wages actually increasing, right? The unintended consequence is that when wages increase, sometimes employers, right, companies actually have to increase their prices, which the unintended consequence is that, unfortunately, inflation might remain higher for longer, which after this jobs number actually came out, one of the other headlines was that, this might actually make the Fed's job a lot harder, right? Does this actually lead the Fed to lowering rates in June, or if they lower it at all later this year? And so when you really think about it, right, as a normal American, people start to get a little frustrated when they think that maybe their wages aren't keeping up with the pace of cost of living.
You know, it's particularly interesting. We were speaking with the Conference Board Chief Economist Dana Peterson about this very topic of wages and especially how it correlates to what Americans actually feel. Of course, the Conference Board puts out their reading on consumer confidence. And as we look across the spectrum here, why do you think, Ross, that many Americans still feel like they might be drowning in expenses, drowning in costs, or combating inflation on their own personal battlefield as well, if wages are higher and inflation is decelerating or lower?
Yeah, well, we also just got to understand what's the starting point, right? Sure, inflation is coming down, wages are increasing, but you got to ask to what end, right? What was the actual starting point? Because as it stands, right, housing is more expensive, food is obviously more expensive, energy prices, right, gas prices, et cetera. So, not to beat a dead horse, but the thing is, you also have savings coming down. And so when it's all said and done, we have to understand that inflation is going to be a lot stickier, right? Employers are probably going to have to continue to increase prices. And for the small part of the economy who are feeling the benefits of wages increasing, well, guess what? That means their demand is higher, which also might keep prices higher. And so at the end of the day, whether we're talking housing, we have institutional investors now being landlords, right? Like housing is a very interesting conversation because when it's all said and done, you have effectively a finite supply, and the demand is obviously continuously increasing, and that's why housing is so expensive.
Ross, we got to leave things there on the day here. Ross Mack, personal finance expert and founder of Maconomics. Good to see you.
Thank you.
Thanks. Well, AI, the great job stealer or job savior? The debate is firmly back in focus here. Elon Musk says Tesla is boosting pay for its artificial intelligence engineers as it looks to fend off competition from the likes of OpenAI. The boom in the sector comes amid a growing trend of business schools offering AI-related courses. So, are we automating away our future? One business school does not think so. The dean of the American University's Kogod School of Business says understanding and using AI is now a foundational concept. Joining us now, we've got the man himself, David Marchik, who is the dean of the American University's Kogod School of Business. Great to have you here on the program with us. Why is this now a new staple, you believe, for the studies at American University, or a core concept that needs to be integrated?
Thanks for having me. We had two speakers last year and earlier this year who really changed my perspective. One was the president of Google, who said that AI is akin or more profound than electricity or fire. And I thought, well, that's a big statement, but what does that mean? Then we had another speaker who was the CEO of a venture capital firm. And in response to a student question on the exact subject you just raised, will my job be replaced? He said, your job won't be replaced by AI, but your job could be replaced by someone who knows AI if you don't. So when I heard that, I said, we need to move with speed to give our students the tools to be competitive in the market when they graduate American University.
You know, it's quite remarkable because we're talking about a change in an addition, I should say, in coursework and curriculum and just the type of pathway that a student can find themselves into for a job that might not even be created yet as well. How did you go about constructing such a curriculum for something that is this cutting edge? Because it was the same kind of thinking that we were hearing or trying to wrap our minds around what universities would do if they were trying to upskill people for blockchain or upskill people for social media back in the day. So how have you been able to go about this at American University?
Our faculty has actually been really responsive and quick. AI has been moving at the speed of light, and academic institutions usually move at the speed of molasses. We were actually able to move pretty quickly. So we worked with our faculty. We had a small committee. They took 6 weeks to look at our curriculum, and we've come up with more than 20 new or redesigned courses to infuse AI into everything we do. I'll give you an example. We have a professor who is a negotiation expert, teaching students how to negotiate. She's already using AI to help students prepare for negotiations. An assignment last week was engage with AI on a debate or discussion with your boss on how to get more responsibility. And AI can actually have that debate with you and then analyze the gaps in your arguments. Then the next assignment was, all right, now imagine that your boss is hostile, difficult, angry. We've all had bosses like that. And so now students can engage with AI to practice and prepare, and that'll help them be more effective in the workplace.
Will this be a concentration as part of an existing major, or does this eventually become its own major?
So some schools are approaching it as an own major, okay? And there's nothing wrong with that. My basic view is that AI is a tool to be more effective in whatever you do. So our school happens to be a national leader in a few areas. Sustainability, we have the top curriculum in the country. Entrepreneurship, one of the best schools. AI will be a tool to help achieve more sustainable goals for businesses and help every entrepreneur create a business, be more efficient, and be more effective. So in my view, AI is akin to learning how to write, to reason, to debate, to communicate. Every student, regardless of whatever their major is, whatever field they go into, they need to learn the tools of AI.
You know, David, while we have you here, I got to wonder for jobs that perhaps don't even exist yet, where there's going to be an AI co-pilot or there's going to be this productivity annexation that all of us are trying to figure out, all right, do we work with or does AI replace some of the monotonous tasks? That is a different set of work, and the scope of work changes, then the pay scale might change as well. And if the pay scale changes, then that also impacts the number of students that are saying, okay, what is the cost benefit that I have to run in order to go to a university and ultimately get skilled for something that the pay scale has changed so drastically? I wonder how you guys are going about that thinking, if this will even change how much college costs as well, because of the scope of work for individual employees changing as well.
It's a great question. And I mentioned that universities move at the pace of molasses. We're trying to move more quickly because students are looking at the value proposition every day. What's the cost benefit of getting an education, either an undergraduate education or particularly in the master's and upper and graduate school area? We need to change faster to be able to better prepare students and graduates for the workplace because of the trends you just talked about. And so we upgrade our curriculum, we infuse professionalism and communication skills into our curriculum, and we want our students to be prepared for the jobs of tomorrow, not the jobs of yesterday. If we don't change, students won't come, and so we need to change.
David Marchik, who is the Dean of the American University Kogod School of Business. Thanks so much for taking the time here today. Appreciate it.
Thanks very much.
Certainly. Coming up, are you new to investing or do you just want to know more about how to balance your portfolio? We've got all the tips for trading levels across the board. That's coming up next. Over 60% of Americans own stock in 2023. That's according to a Gallup poll. If you're part of the minority that does not, it may seem a bit intimidating to start, but if you're already trading, are you sure that you're setting your investments up for success? To break down how new and old traders can trade smarter, we've got Adel Zaman, who is the Wall Street Alliance Group partner, here in studio with us. Great to see you.
Great to see you, Brad.
All right, so first and foremost, let's just get to some do's and don'ts for first-timers out there, and perhaps for some who have been involved in the equity markets but have already made some unfortunate mistakes.
Yeah, I think one of the basic principles is always invest for the long term, right? So with all this meme stock frenzy and with Robinhood traders, coming in, we tend to see a lot of people are looking for short-term trading. I think that's a mistake. Most people lose money that way. Have a long-term time horizon. The S&P 500, there's never been a 20-year period where the S&P 500 has generated a negative return, right? The 20-year average return of the S&P 500 is more than 9%. In order to make that return, you have to stay invested for the longer period of time. In fact, we tell clients if you can't invest for 5 years, you shouldn't be investing in the market.
Interesting. Okay, and so what are some good first trades for first-timers, perhaps?
I think that if you're investing for the first time, it makes sense to look at ETFs. That's an easy way to diversify.
A basket of securities.
A basket, rather than going for individual stocks because that can be risky. Get a feel for the market with ETFs, and then dip your toes more with individual stocks later.
What are some of the strongest themes that you're seeing in tracking within ETFs at this juncture?
I think that, with ETFs, the index ETFs, they are a great place to start with S&P 500 index ETF. And then as the size of your portfolio grows, you can have more individual stocks and create a more diversified basket. I think one of the key things, Brad, that people miss out, it's boring. But, if you're starting off, always remember, be diversified, right? When the tech bubble burst, a lot of people lost their shirts because they were heavily invested in technology. And they never recovered their money, right? On the other hand, people that were well diversified, they recovered and they've made more money over time as the market went up. And another mistake that we see people make is that if the market's down, they'll say that my 401k, I'm not even going to take a look at it. It's going to be fine. It's going to come back up. That's a mistake because the market may recover, but what you're invested in may never come back up. So you want to make sure you're diversified properly to recover with the market.
Is there a way to take advantage of downturns or drawbacks in the market?
Well, like Warren Buffett said, be greedy when others are fearful, right? Market drawdowns are sometimes the best opportunities, right? It's not only the best opportunity to buy good quality companies at 20, 30% discounts, but it's also a good opportunity to implement certain strategies such as tax loss harvesting. What is tax loss harvesting? Tax loss harvesting is that if you have a stock in your portfolio that's down, you sell it, as long as you don't buy it back within 30 days before and after you've sold it, you could take that loss to offset capital gains in stocks and in real estate. And what a lot of people miss out on, Brad, and don't understand is that this loss can get carried forward indefinitely into future years. So we used this strategy extensively in 2008. After that, the markets and the real estate went up and clients were able to use those losses to offset those gains.
We're going into a fresh earnings season. What do new investors need to remember about earnings season generally here and how they can aptly trade during that time as well?
I would say, if you're a new investor, don't really worry about, the short-term earnings. Think about it from a long-term point of view. If you're a new investor, don't be afraid to sell a stock if it's down. Sometimes it makes sense to put a bullet in it and put the money into something else which will go higher, right? Which has a greater likelihood of going higher. Another mistake that we see that people tend to make is that they don't want to book profits, right? Like, for example, if you pull up the 5-year chart of Tesla,
right,
you will see that the stock had a monster rally up until November 1st of 2021. And since then, it's down more than 50%, right? We're seeing something similar play out with NVIDIA, where people don't want to sell it. It's gone up. You don't want to take any money off the table. That's a mistake. Book profits. Take some money off the table. No individual stock should be more than 5% of your portfolio.
Interesting. Adel, great to have you. Great to see you again. Adel Zaman, who is the Wall Street Alliance Group partner. Thanks.
Thank you.
Well, over 51% of 15 to 18-year-olds failed a national financial literacy test in 2023. This is according to the National Financial Educators Council. And without a formalized personal finance curriculum, kids can really only rely and pick up on that education at home. So, for how to transform the way that you and your family think about money, we've got David Delisle, who's the money mindfulness expert and author, here with us. Great to see you, David. What is the first way that perhaps people come together, families come together around the kitchen table and just set up the first steps towards financial literacy within the household?
Yeah, I mean, I love that you mentioned around the table, because that's the thing is usually we make this something that's much bigger than it needs to be. It's simply just having conversations about money. We don't tend to do that. We don't do that within families. We don't do that with friends. We don't do that outside. And the more we start talking about money and just having these conversations, the more we start to understand these basic concepts.
And sometimes it starts with collectively goal setting as a family too. You have something that you call the vacation tactic. Walk us into that.
Yeah, I mean, vacations are such a great opportunity. I mean, we just came out of spring break for many of us, and it's such a good opportunity to teach some of these things to our kids, because if we're trying to teach them these things like lifelong goals or budgeting or doing without, it's sort of hard with the time frames. But with vacations, we can simply give them the money we plan to spend on them anyway for, treats and souvenirs or toys or ride tickets, and let them start making those decisions. And the stakes are low. If they end up spending all their money, that's fine. If they buy stuff they didn't like, that's fine. It's a great opportunity for them to start having a little bit more autonomy, understand the value of money, and making some of those decisions themselves.
I mean, this is a mindset change that families, individuals can implement. How do they ensure that they can sustain that over time?
So something I love to do is really, instead of focusing on the money aspect and how to have more, is focusing on like the why, the what really brings you joy, what I call the awesome stuff, especially for kids. I got 2 young boys, so they love that idea and that concept of the awesome stuff. So understanding what really is your awesome stuff, and then that mindfulness piece, like you mentioned, shifting that so it becomes a question, is this my awesome stuff? And that becomes the deciding factor whether or not you want to have something. And usually that awesome stuff is that feeling, like how does something make you feel? And I mean, adults can definitely learn and benefit from this as well.
There's one other concept that you talk about a lot, which is loud budgeting for families. So, I mean, beyond me just yelling how much I spent when I left, or once I come back in the house, what does loud budgeting look like in practice?
So this is back to just that idea of having these conversations, and we're not having them. So something like this is as adults. So if your friends are asking you to go out and you just don't really want to go out because it's too expensive, but we're so ashamed about money, we might just say we can't go out or we're not feeling up for it. Instead, letting people know what your financial goals are, telling them, hey, I'd love to see you, I'd love to go out, but I'm trying to save money, I'm trying to pay off this debt, or this is what my priorities are, or this is what I'm saving up for. And focusing on telling people, like that loud isn't about yelling or screaming it. It's about bringing your actual financial, goals and achievements out into the open and having those conversations instead of hiding them.
Look, I'll give a freebie out to our viewers. I usually just tell people it's a financial stabilization weekend for me. Sorry, can't do it. All right, David, we got to leave things there. David Delisle, who is the money mindfulness expert and author. Thanks so much.
Thanks so much. It's great being on here.
Likewise. Coming up, younger generations likely to start seeing wealth windfalls in the coming years. We'll break down why and how women stand to benefit big after the break.
The great wealth transfer will occur as the boomers begin to pass away, as they begin to hit 80, 79, 80 this year. That money is going to go to millennials, it's going to go to Gen Zs, it's also going to go to women.
That was Sally Krawcheck, Ellevest co-founder and CEO, speaking to us about the great wealth transfer. It's expected to move $84 trillion in wealth to younger generations through 2045, and women are likely to see the biggest impact from it. That's according to a Bank of America study here. Let's bring in Dimple Gosai, who is the B of A head of ESG research, to discuss more. Great to have you here in studio.
Thanks for having me, Brad. Lovely to meet you.
Likewise, let's talk a little bit more about this great wealth transfer and the type of opportunity for the next generations as well to not just come into wealth, but also manage it correctly as well here.
Lots to unpack there, Brad. So firstly, $84 trillion, you hit the nail on the head. That is what's been expected to be transferred to the younger generation through to 2045. But more importantly, $30 trillion will be going to women in the next decade. And that is primarily because of inheritance, where 2/3 of that money will be coming from baby boomer men to their wives and children. However, that's going to have an impact not only to companies, but also to the economy and obviously the stock market, right? So this is going to have a windfall impact on different companies, different sectors, and industries are going to have to adapt, which we can talk about shortly. Lots to unpack there. But as you rightly point out, women do invest differently, and that's something that we need to address. I'm not saying that, we need different products that are catered towards women to adjust for this, but customer services need to change, marketing needs to change, the way that we appeal to these investors need to change, because women prioritize differently when they manage their wealth.
What is the biggest delta, perhaps, in the type of fund flows that we might see as women are coming into wealth from the great wealth transfer and investing differently, as you were mentioning?
Right. So women tend to have a lower risk tolerance in general, and so they tend to prefer passive investments as opposed to single stock investing. But I will preface that by saying that today, when I look at Bank of America 401k data, there is a greater allocation that is put towards equities. Today, that stands at 8% versus 5% 3 years ago. So that's one factor. The second is impact investing. That is something that women deeply care about. So looking at around 8,000 different customers across 16 different jurisdictions, 55% of women said they are more likely to invest in a company if it were to appeal or speak to their personal values.
That's major here, and especially as you think about which companies are going to have to change their tune on many issues out there. As we think about going forward from here, and the different generations of women as well that this is set to impact positively, and then additionally here, where those purchase decisions will be different, investing decisions will be different, relationships with banks, institutional firms will be different as well. Are we already seeing a change in some of that?
100%.
Yes.
So today, women are graduating at a faster rate than men are in the US, right? What does that mean? It means that they're entering the workforce at a higher and faster level. It means that we are earning more money versus the past. Look, the wage gap is still stark. Women still earn 82 cents for every $1 that a man earns. But higher earnings, delayed marriages, and having fewer children means women have more control over their finances today sooner and longer, which means that they're more able to buy a house or a car versus previous generations, right? And in fact, when you look at the baby boomers, or more specifically Gen X, they're actually making independent financial decisions more so than their male counterparts. And just to allude to one more thing that you mentioned here, Brad, you rightly pointed out, different sectors will have to adapt accordingly.
Is there one sector that's anticipated to be perhaps to see a windfall, or perhaps a thrust forward of even more activity?
Let's talk about the consumer sector,
Sure.
right? And specifically luxury.
Yeah.
Right? Today we know, as I alluded to, women are getting married later, less children. So obviously childcare spending goes down, right? Diapers, bottles, so forth. But luxury, on the other hand, is a sector we need to talk about, right?
Yes.
Women were already buying luxury brands, handbags, shoes but now they're buying their own fine jewelry. So an interesting study, a quote from Pandora Jewelry, is that the search term for buy myself a gift has risen 400% over the last 5 years.
Wow.
And this is already being seen, in data from China. For example, when we look at jewelry that are, gold, platinum, diamonds, 30% of sales today are for self-wear.
Wow. Okay, I didn't know that stat. That's really important. And I mean, it really spells out the type of shifts that we're going to see in spending, in investing, and wealth management as well. We have to leave things there today. Dimple Gosai, who is the Bank of America head of ESG research. Thanks so much for taking
Thank you for having me, Brad.
Absolutely, appreciate it. And today we're examining a topic every one of us cares about, our paychecks. Fresh data reveals the gap between what people are earning when they jump jobs versus what they earn when they stay put. Yahoo Finance's Molly Moorhead has the full breakdown here for us. Hey, Molly.
Hey, Brad. This is coming from new data from ADP, which found that the year-over-year median increase to people's pay when they stayed in their jobs was about 5%. But for people who changed jobs, it was 10%, double the pay increase on average for job switchers.
So how does the job market look overall then?
It's looking good. We just got the official government jobs report this morning, which found 303,000 jobs were added in March, and that exceeded expectations. The number has exceeded expectations every month of the year. In addition, the unemployment rate has inched down. So it's looking good for the rest of 2024.
Yeah, we got a deluge of employment situation type of and labor market data over the course of this week, whether that's ADP private payrolls, whether that's today's monthly jobs report, and for those who nerd out over the Paychex small business report like I do, you got that one too. So what should job seekers do to get in on this train here ultimately and make sure that they get a nice pay raise when they land a new role?
Yeah, one thing is to be aware of wage transparency laws. More states and cities are passing these laws which require employers to include a salary range in their job ads. And I would say, even if there's not a requirement, ask upfront what the position pays. There's nothing worse than getting through 3 weeks of an interview process only to find out the position you're applying for pays less than what you make now. The second thing is to negotiate. This is not new advice, but it's also not easy for a lot of people. And if you are not real confident in your negotiating skills in the moment, then when you receive a job offer, respond with a thank you and say, I want to take a look at this, and then get back to you. Then in your own time, study it. Look at the total compensation, including benefits and potential bonuses, and see how you feel about it in relation to your own experience. If you have been offered something at the bottom of a pay range and you've got several years experience in the field, then that could be part of the case you make for coming in at a higher level.
All right, some really solid tips and reminders here. Our own Molly Moorhead. Thank you so much, Molly. Great to see you.
Thanks, Brad.
Coming up, is student debt weighing on you? Well, we're going to explore how you might be forgiven. Forgiven! It's right after the break. The Biden administration proposing to reduce or eliminate student loan balances for millions of borrowers, according to the Wall Street Journal. The regulations set to be issued as soon as next week. This comes after the Supreme Court overturned the administration's first debt cancellation plan last year. Well, if this latest attempt doesn't pan out, again, what can you do to lower your student loan balance? For more on this, we've got Betsy Mayotte, who is the Institute of Student Loan Advisors founder and president, here with us. Betsy, thanks so much for taking the time here with us. First and foremost, there's a deadline to this, and the April 30th deadline that a lot of people might have been getting notifications about already. What do they need to know about that deadline?
The deadline has to do with borrowers that might benefit by consolidating their federal student loans to take advantage of something called the one-time account adjustment. Now, to be clear, most borrowers aren't going to have to do anything to get this adjustment, but borrowers who have older FFEL or Perkins loans, or maybe they have loans that have been in repayment for different periods of time, they are going to want to consolidate by April 30th to get the most benefits they can out of this one-time adjustment.
How do people apply for that? Do they need to apply for that?
They don't have to apply for the adjustment. If they have federal direct loans, that adjustment's just going to happen. But if they do need to consolidate, they can do that online, super easy, at studentaid.gov, which is the Department of Ed's website.
And then loan forgiveness. I mean, this has been what so many borrowers have been waiting for, trying to make sure that they are qualifying for as well. What are the prerequisites for those who do qualify versus don't qualify?
Yeah, so what the one-time account adjustment does is it gives borrowers credit for every period that they've been in repayment towards the forgiveness component that exists under the income-driven repayment plan, such as the SAVE plan that we've heard so much about. So normally to get forgiveness under those plans, you have to be on the plan for either 20 or 25 years. But this one-time account adjustment will give you credit for all periods you've already been in repayment, even if you weren't on one of those plans.
We know that this has been on the docket for the Biden administration multiple times at this juncture. What's the likelihood that we see a different result this time?
Well, this particular one-time account adjustment is already rolling. I think at this point, they plan to have all the accounts adjusted by the fall. I am cautiously optimistic that this particular waiver is going to be left alone.
Interesting. Why is that?
Because it hasn't been killed yet, and we're sort of already halfway to the finish line. It's much harder to unwrap accounts that have already been adjusted and people that have already had forgiveness than it is to stop something before it started.
Certainly. Okay, so everyone is going to need to be on an income-driven plan to accrue the rest of the payments needed for forgiveness, right? And how do they go about setting that up correctly?
Most borrowers, again, just need to go to studentaid.gov. There's a couple great tools there. One, a loan simulator tool, which is a calculator that'll tell you what your payment will be on each plan and whether or not you'd end up with some forgiveness and how much it's going to cost you over time. And then you can also apply for the income-driven plans right through that website, regardless of who your loan servicer is.
Are people able to, if they've been paying for 20, 25 years, 2 decades we're talking of payments, are they going to be able to apply for, I don't know, some type of refund or anything?
After the one-time account adjustment is done, if it turns out the borrower made more than the 20 or 25 years worth of payments, and they haven't consolidated recently, then they will get an automatic refund for those extra payments.
Really interesting. Betsy, thank you so much for giving us the tips that we all need to navigate some of these student loan payments out here. Betsy Mayotte, who is the Institute of Student Loan Advisors founder and president. Thank you so much.
My pleasure.
We've got much more on wealth after the break, everyone. You're watching Yahoo Finance. Spring is in the air, and you know what that means. It's March Madness time. Get them brackets ready and get the red pens ready as well, because you know yours is busted. This year, after the game of his life, Jack Golke of Hillsdale College capitalized on his growing spotlight to thank not only his coach and also his team, but also TurboTax. Golke had secured a name, image, and likeness deal, otherwise known as an NIL. You have probably heard the term NIL thrown around during the past few years, but you may still ask yourself, what does it really mean? And is it truly a good thing for college sports? The NCAA is a multi-billion-dollar industry, bringing in the big bucks for universities. The Ohio State University athletic program, for example, raked in more than $250 million in revenue in just the fiscal year 2022. But what about the players? In recent years, they've refused to sit on the sidelines in silence. In 2021, the Supreme Court ruled on the side of the players in the NCAA v. Alston, stating that universities are not exempt from antitrust laws. Now it's legal is another way to understand NIL. It is now legal for college athletes to monetize their rising star power, and the spotlight is never bigger than during March Madness. These students are now bringing in more money than ever before. USC freshman basketball player Bronny James, son of King James, LeBron James, worth an estimated $5.9 million. Iowa University's Caitlin Clark and LSU's Angel Reese earned $3.1 million and $1.8 million, respectively. And NIL, it's got two separate markets that you need to know about. The first is largely brand deals. Athletes are paid to promote content or products on their social media channels. The second market involved in this new NIL system are donor-funded groups called collectives. Many of these collectives are 501c3 nonprofits, meaning donations are tax deductible. These collectives allow athletes to take in de facto salaries, and college athletes can now shop around for the best deal and are less likely to remain tightly bound to their original school, hence the transfer portal. Although this allows players more agency, the question remains, has it turned college sports or the NCAA into a mini NBA or professional level? We'll continue to be on the lookout for the domino effect NIL has throughout the financial landscape of college sports, right here on Yahoo Finance. Like the rapper Curtis Blow once said, basketball is my favorite sport. I like the way they dribble up and down the court. With the men's and women's college basketball championships wrapping up this weekend, there have been a lot of conversations about player compensation. I had the opportunity to chat with former NBA star and current proud college athlete dad, Jamal Mashburn, about what he teaches his son about his own wealth and managing his financial future. Check it out.
First thing I chatted with my son about in any potential NIL deal is taxes. You know, we got to pay taxes. How do we allocate that money for taxes? And then how do we allocate money for saving? And then how do we allocate money for charitable giving? You know, so that's how I kind of go about it. And then what do you want to live on at the end of the day? So, you know, I use the opportunity for NIL to really talk to kids about finance. And I think that's a conversation that is not necessarily had in certain households, or some people are maybe uneducated about finance. Or you get in front of a financial planner, at least you know, have insight, and you can ask the right question. You know, so that's how I approach it. I look at NIL as an opportunities for these young men and women to really get involved in finance and how they take care of themselves. So we can no longer hear the stories of back in the day where professional athletes went broke. You know, so I think NIL can help with that. I mean, you'll have some missteps along the way and different things like that, but I just hope they approach investing, taxes, and finance and savings in a different way, because now they're intimately connected. You know, it's no longer a pipe dream.
I also had the opportunity to speak with trainer to so many NBA stars and founder of Black Ops Basketball, Chris Brickley, about how his views on his own personal finances have shifted over the year as well.
Before I even get into that, shout out to my financial advisor. So that was a few years back. I didn't understand the whole aspect of, okay, when you make $1 million, $500,000 that's going to taxes, and then you got to pay your manager, and then you also want to save some of it, and that was a whole. So Jared Finkelstein, I have a really good financial advisor. He's really well known. He works at Merrill Lynch. He has a great firm around him, and he's just explained to me, it's not about how much you make, it's how much you spend, and just investing our money and putting in things that I can't touch. Just growing up without much money, it's like, you always, there's certain things there's a certain lifestyle that you always wanted to live. Then once you get there, you realize, okay, there's only so many shirts I can buy, or watches or sneakers. It might make you happy for a day or for a week, but it doesn't. That doesn't really do it. So I think what I've learned is just saving my money, trusting in the people that's their jobs, and it's and I'm still learning, but it's definitely something that I'm figuring out every day, the whole wealth aspect of it.
And finally, I was able to sit down with the former CEO of the Philadelphia 76ers, Scott O'Neil, on his financial advice for athletes.
My advice would be, one, work unreasonably hard. 2, be intellectually curious. Don't have a fixed mindset. And 3, be an extraordinary teammate. And I don't mean often on the pitch or on the court or on the field. I mean, truly figure out how to leverage the opportunity you have and the people you have. If you were a college athlete, do you know the alums? Do you know the people sitting courtside at your games? Or do you know the ones coming to the game? What are you volunteering for and towards? Who do you know at the school that can help you along your way? Because there are the college athletes that will be pro athletes and be able to make a sustainable living. It's probably 0.1% or 0.01%. It's the everybody else that I want to spend some time on.
And my thanks to Jamal, Chris, and Scott for their time, as we really got a well-rounded conversation there on NIL and how college athletes can benefit in the future as well. Let's do a final check of the markets here. Stocks right now, they're up across the board for the U.S. major averages. The Dow, the S&P 500, and the NASDAQ all seeing green, led by the tech-heavy NASDAQ on a percentage basis, up by about 1.4%. S&P 500 up 1.25%. Dow up by about 1%. The big news driving the market action this morning, of course, that March jobs report. The U.S. adding over 300,000 jobs in March, blowing expectations out of the water. Unemployment also ticking lower, showing that the labor market remains on strong footing. That is it for us right now. Thank you so much for watching. I'm Brad Smith. We've got much more wealth next meeting.